lots of money. Oh, but that's okay. I am with you, with you. Oh, man. Your boy Kevin just lost lots of money. Oh, but that's okay. I am with you. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it. Oh my God, what's happening?
First of all of this whining by Wall Street is making me sick. 140% of GameStop was short. GameStop was short. You can't allow Wall Street to short 75% of its stock, crush these companies into the dirt, thousands of stocks into the dirt. Then when the individual makes money, everyone's entrepreneurs. I have a kid who bought a house, paid $50,000 and bought a house. After decades of the shorts, you have to accept the fact that individual investors are playing the same game that you're playing, and now you're losing.
Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it. Oh my God, what's happening? Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, push it, push it, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it. Oh my God, what's happening?
There's a lot of power in organization online. 2 million people can get together in a subreddit. I think it's really funny that the GameStop stock is going up and just affects the market in that way. There's 20,000 people live in a Discord who are spamming rocket emojis, yelling, "Go to the moon."
Man, that was awesome. I love that thing. Welcome on back. Woo! Today is Jackson Hole. Good old J-Hole. Some nervousness might be left over for J-Hole, which is what I think is the case. Honestly, this is a clearing day. Gotta get this bullcrap catalyst out of the way, and then let's go. We get to pump. That's at least the goal, that today is a clearing day. Speaking of clearing day, it's also a coupon expiration day. It's coupon code J-Hole, appropriately and aptly named J-Hole. A reminder that this is not just for the Meet Kevin Alpha membership over at meetkevin.com, but if you want the Homes AI product and you are a course member, you could email us, say, hey, I'm a course member, here's my email, I want to bundle up to Homes AI. The reason people are doing that is we are getting rid of the lifetime access for Homes AI, the ability to sign up for that. Obviously, if you sign up for something that's lifetime, you're going to keep lifetime, right? But we're bringing that over to a subscription model, so keep that in mind. Okay, with that sort of housekeeping out of the way, let's, and the email is staff@meetkevin.com if I didn't mention that. So, hey, I'm a course member, I want to bundle up. Or if you're not a member yet, you could obviously sign up for the Meet Kevin Alpha report over at meetkevin.com. And then you're a course member. If you want, you can bundle up on over. So we'll see. Today we'll have another test here on 227 for NVIDIA, pretty critical line. We did lose it in the post market. We lost, it was a little aggressive yesterday. Maybe had some trading enthusiasm, but we've got a few. We had at least 2 big rejections yesterday on 227. Actually, during the trading day, we lost it after. Some of this rally into the close here was probably leveraged ETFs buying. And based on a beat on top and bottom and forecast on Marvell, it's obviously volatile. This thing goes up 10% one day and then it's down, 6% or whatever. But Marvell should recover if NVIDIA really holds a balance here. So we'll see. A lot of this is going to be predicated on, do we end up getting rug pulled by Kevin Warsh? Me thinks no, but we'll see. So we'll be looking for exactly what he's saying. His speech is supposedly going to start at about 30 minutes. I think it'll probably be like 35 minutes or whatever. And we'll get you taken care of with insights into Mr. Warsh. And I think, what else do we have? Once we got Warsh out of the way, we got NVIDIA out of the way. Who cares? I mean, what's another catalyst? What, ADP Weekly? Dude, nobody's going to care about the ADP Weekly next week other than me. So we'll get ADP Weekly coming up, and let's take a look at the Catalyst calendar. We'll have CPI. Nobody cares anymore about CPI. It will be a wait for, is it going to force the Fed to act? But, I mean, let's look at the expectations for it. We've got JOLTS coming up on September 1st. We're expecting 7.38, ISM manufacturing, whatever. I mean, these are cool to read, to see what's going on. ADP Weekly forecast is at 48,000. That's very consistent. We're staying stable over here, which is good. What is this? Okay, let me go out. Hold on. Okay, let's go out to this. There we go. Okay. Then we get, let's see, 9/4, we get change of non-farm payrolls expecting to be 55,000, private payrolls 50,000. That's pretty stable. Labor force participation rate expected to be stable at 6.1. CPI is on 9/11, and we do not have forecasts yet for CPI. Okay, big deal. None of that so far is nerve-wracking. I mean, we basically got no catalyst. Let's get the bell.
A lot of it is because of Ross Stores. They had a 10% comp, and that was Jim Conroy from Boot Barn came in, and really it's kicking butt. It's a lot of share shift. Yeah, TJF, eye off the ball.
Let's get the opening bell here on this Friday at the big board on Wall Street. It's Presidian Investments celebrating the trading of its ADR hedge products at the NASDAQ in Times Square. Miami Biotech Collective, a group focused on South Florida's biotech ecosystem. And at SIBO in Chicago, it is the SIBO floor operations team. Jim here is where, 77.40s, actually not bad progress, although halting progress over the last few weeks.
I just think that one of the things that it's very discouraging.
Welcome to the market open. So what do we got? I mean, there you go. Very first few seconds of the trading day, NVIDIA struggling with that 227. Come on, baby. Hey, we got to get through Warsh. But that's it, man. What? Please, somebody tell me, what other freaking catalysts do we have? There's nothing left. CPI 9/11, who cares? Fed Day, September 16th, who cares? It's not going to hike right before the election. I mean, what's the Fed calendar? Let's look at that. So the November date, I know December 9th is after the election, but what's the November date? So FOMC schedule 2026. It is, it's October. Oh, right before the election. And September will include a summary of economic projections. So it's it's September 16th, October 28th, right before Halloween. That's spooky. And then December 9th. I don't think there's a way they hike before the election. There's no way you get Kevin Warsh to enable that. He's gonna be like, guys, the task forces are gonna be ready by December. Why don't we wait for the December meeting? So yeah, we're out of catalysts, which is a good thing, I think. But once we clear Jackson Hole here, we'll have to see if NVIDIA can actually hold on to 227, because it really deserves to break out of this. It's getting so much spend from your, SpaceX, your Google, whatever, the neoclouds. The neoclouds are relatively small in terms of how much they're spending compared to the big guys, but it really justifies a higher valuation. But the fact that it's lagging is disappointing. And then it makes you sort of wonder, like, are we in a bit of a profit take mode? Are we in a bit of a lack of cash mode? What's going on over here? Why don't we have some more enthusiasm? So we'll see. But anyway, that's obviously in 30 or so minutes. We'll have Jay Hull, which is great. Then we've got, let's see what else we got. We have there is a piece that I want to go through on hardware. We'll go through that together in just a moment, because somebody put together this. Oh, where is it? Am I going to have to airdrop it to myself? Yeah, it's on my phone. I read through and commented on this whole piece yesterday of somebody who's, clearly this hardware bull, and it's fine. I think it's actually a good piece. I get their argument, but I also have my disagreements. Oh, it's right there. Okay, it did make it through. Okay. Now I have it twice. Okay, so this is going to be, we'll call it the hardware bull case with commentary 2.8. Okay, so we'll pull up this, and then we'll go through a little bit of. Again, there's some parts in here where it's like, all right, I get it. They've got some arguments, but they've also got some parts where they go a little kooky dooky. And I think one of the reasons we're having such a slow start like this, it's such a heavy weight of trying to get NVIDIA over 227. I think one of the reasons we're having this almost schloggy behavior is because people are kind of like, I don't know, I'm skeptical of the bull case, right? Some of that hardware skepticism, I think, is indeed weighing on markets, at least in that hardware sector. So we'll go through this. I think they did a great thing. I mean, they probably wrote all this crap with what's it called? AI. It's just sort of the irony of it. But, I like to actually read stuff. I mean, I don't like reading, but I just think it's a good idea to read. So I read all this, and this thing is long. How long was this? I mean, it definitely put me to sleep. But yeah, this was like 6 pages of writing here. So we'll just go through the highlights, and I'll talk to you about the takeaways. So let's do that. Let me take a sip of coffee here, and then we'll go right into this. And obviously, if you do not have a 227, I think it's 06 line drawn for NVIDIA, pretty critical. You can see we are trying to recover that. What you should do is, let me see if we could do that. Oh, okay. I have to make can I make it NVIDIA? There we go. I now put NVIDIA at the little top where I had Bitcoin. So that way when I'm on a different page, I could still see NVIDIA right there. Although it's so hard with the liquid glass from from Apple sometimes. Come on, baby, push! All right, let's get into it. So where are we? All right, here we go. And pop this up right here. The 2026 AI semiconductor endgame. Does compute math still pencil out? We've got a viral 6-page analysis on whether or not compute still makes sense to invest in. Does it still make sense to invest in hardware? Is it a bubble? When does it end? The piece actually asks quite a lot of questions and provides their perspective on a lot of these. For example, after coding, what's the next leg of annual recurring revenue? Do the economics work? Why is this different maybe from the internet build-out? Yes, the famed words this time is different. I went ahead and went through, summarized all of this, and commented on all of it. So we're going to point out the highlights and what their argument actually is, because frankly, a 6-page piece is a little dense to read. So we'll get to the bottom lines of it. So let's get started. The first argument that they make has to do with this idea that there's a different form of exponential growth that we're seeing today. There's a risk with this argument, but I understand what they're saying. They're basically saying, back in the internet build-out day, you would basically just have people times a flat rate, and that's how you'd be able to make money. So your S-curve was really built by how many people can you serve times a flat fee, $49 a month or whatever. Here, they actually argue you have something different. You have people who are using AI times tokens, and you actually have 2 S-curves here. So you have the exponential growth in people using AI, and then you have how much AI they're using. And then you could kind of multiply these 2 S-curves and suggest that the hardware rally deserves to go on a lot longer than the internet or .com bubble era, because you have that extra vertical, basically, or that extra multiplier effect. I get that argument. The problem that I find is I don't actually think usage by users is exponential. Mostly because even if I go from using 10 tokens to 100 tokens to 1,000 or 10,000 tokens, that is an exponential curve, but it's anchored by rapid depreciation in token costs. And there is a limit to how much I'm actually going to use tokens. Like, how much do I really have to talk to AI? There's a functional and practical limit. My time, productivity, revenues, budgets, whatever. But in addition to my limits on how much I actually need tokens, we should, put a little down arrow anchor on this, which, they don't mention, that tokens are a rapidly depreciating asset. And people forget this. Remember this, when it comes to tokens, I can go use a Chinese model from Alibaba called Quen, and I could spend 41 cents for 1 million output tokens. If I go to the Frontier Labs, who are the ones spending on NVIDIA like drunk sailors, if I go to them, I end up spending $50 for 1 million output tokens on Fable 5. That's crazy. That's a huge difference. And we're just at the beginning of sort of that depreciation phase. So, I don't know that I agree that this time is different because tokens are a multiplier effect. I think the anchor of them rapidly depreciating kind of kills some of that argument. So that was my sort of rebuttal to that take. Then they go on to say this. They say, tokens per person, the median AI spend inside US enterprises is currently $12 per person per month. Long term, that number could plausibly reach 10% of the average white-collar salary, roughly $12,000 a year or $1,000 a month. So my reaction to this is, you're going to get laughed out of any business that is outside of coding if you go to them and say, you need to pay $1,000 a month for ChatGPT. Like, dude, 90% of American businesses are gonna laugh you out of the building if you say that. Like, there's only so much your dental hygienist needs a chatbot, an LLM for, and it ain't gonna be a $1,000 subscription, right? So, like, I think they are looking at this AI build out a little bit with rose-colored glasses here. This is one heck of an optimistic read that we're gonna get to. Every employee is associated with a mostly because I don't think that's where the value chain accrues. I think in AI, you have the infrastructure layer that depreciates, the token layer that depreciates. The layer that wins is software because they're the true bottom line value providers. Like, using the dental example, if I have an x-ray machine that automatically, identifies the odds that a certain spot on your teeth in an x-ray scan or image is a cavity, well, great. I'll pay a certain amount as like the dental office for that software, but I highly doubt it's going to be $1,000 per employee per month, right? So we're going to pay for the value of that output. Sure, that might be worth something on a monthly basis to the entire dental office, but I don't think it's $1,000 a month per employee. Anyway, that's just an example here. So they do rightfully argue that all exponential growth does end up hitting a ceiling at some point. So, like, I do think they recognize that there is a limit, but some of their assumptions are very, very bullish. Okay, fine. Then they go on to say the marginal cost of copying, blah, 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 what is this? Okay. The other reason the AI build-out demand runs higher is that the internet was, let's see, penetration dimensions converted into single unit tokens. Okay, this is basically the idea that in the internet days, there is no extra cost to producing a marginal set of revenue. You just let somebody have a copy of a CD, basically. You sell software, you make more money, you make more margin. With tokens, there is cost. And that's true. But the question is, how much does the cost of a token stay above its cost to manufacture that token? I think that actually becomes really low margin, whereas software stays high margin. So the point of software is you're selling subscriptions that are at like a 75 to 90% gross margin. With a token, in the future, I think it's kind of going to be like mining Bitcoin, where you're mining Bitcoin at a cost of $90,000 and you're hoping to sell it for like $91,000. Like, that spread's really going to compress because anybody can do it. You set up the server farm, right? Okay, another kind of note to keep in mind. Let's keep going. They then go on to say that you could basically brand everything as coding because they say, hey, what's the next coding for AI? It's coding. That's the argument they make. They say, oh, AI for science, that's just coding. AI in financials or business, it's all coding. That's fine. You could kind of rebrand and say everything AI turns into coding because, frankly, behind the scenes, it is just a form of code. But that doesn't really change how much people need AI. That's just sort of a redefinition of, how you brand AI. Big deal. The difference, and this is the part that they don't touch on, is they get really excited about growth rates that have come out of Codex, which is a new product. So you're comparing to low growth rates. And so it's nice and easy to say, oh, Codex is growing active users 108x in legal, 41x in sales. Yeah, that's great. But we're comparing to a base of nobody having used Codex 6 months ago. So this is sort of another hard comparison to make. Ultimately, I have a concern that, we had this sort of growth in AI, then we had the Claude Code and Cowork moment and a Codex moment. And then my concern is, was that moment just this portion of the cycle? And are we now here? That's I think the reasonable portion to look at. Somebody writes, Excel is just coding, right? Right. I mean, yeah, you could brand everything as coding, right? That's the idea. They did write that in here somewhere. So that's, another challenge that I have with this piece. Then they go over here and they say, here's the thing. Anthropic, the only reason Anthropic slowed down its revenue in June and July was because they don't have enough compute. There was an anti-distillation crackdown that shut down a lot of accounts, and Codex competed with them. Okay, all of these are reasonable. If you shut down a lot of accounts, you're going to lose revenue from those accounts. If you don't have enough compute to expand, totally reasonable that your growth slows. And then you have a big competitor that enters, totally reasonable. But they missed the most important one. They missed the most important profit margin bottleneck that gets crushed by open weight. That's the example that I made on the whiteboard here, where why am I going to pay $50 for a Fable 5 million token output when I can pay 41 cents for Quen and it's 95% as good? Going back to the person's argument of we need AI in life sciences or in, my spreadsheet or whatever. Am I really getting, with a good, well-structured prompt, that much more value? Am I really getting 100x more value from Fable 5 versus Quen? Probably not. Maybe you're getting 10% more value, but that justifies another 4 cents of cost, not, $49 in cost. So that's a problem that they don't mention in their bull case here. Although they do reasonably argue that there are reasons why Anthropic's revenue slowed. Okay, fine, totally fair. So then they mention here, they talk about Anthropic's potential growth. And this is where they really show their bull case. So what they're saying is that they actually believe that Anthropic can grow revenue right here. Listen, let me just read you this line. In 2028, where there's no visibility, you can only guess. So if there's no visibility, let's just guess the following. We're going to guess that in 2028, Anthropic can grow annual recurring revenue 80% in the year, which then justifies 7 times as much compute as OpenAI and Anthropic have today, because they've got about 6-ish gigawatts of compute. They're saying if they can grow revenue 80%, we can grow, gigawatts of compute to 45, which again is 7x today. And then if annual recurring revenue doubles again in 2029 and 2030 between the two, CAGR of 40%, then OpenAI plus Anthropic's 100 gigawatts of planned compute by the end of 2030 is totally reasonable. Okay, wait a minute. There's so much to unpackage there. We're just going to unpackage it very simply. Today, we sit at 6-ish, maybe 7 gigawatts of compute. They argue that in 4 years, we could justify 100 gigawatts of compute and still see OpenAI and Anthropic's revenue growing at a 40% compounded annual growth rate when this is their competition. I don't see it. I don't see it. I think compute can go to 100 gigawatts, sure. But I think a lot of that will end up being open weight compute. And they do address the open weight compute issue, which I got a little disappointed by. So right here, this is their argument. They make the argument that they call it closed source. They say closed source versus open source. I can't remember if it was right here, but wherever they mentioned it, I'll find it. Oh yeah, here. So open router. Okay, right here. So they make the argument that closed source, like the Frontier Labs, are actually going to be able to maintain their moat, because if you go to the open source products, you're going to have engineers who can run those open source models, and you're going to have to spend compute on those open source models, and you might end up not optimizing well. There it is. If the open source model isn't optimized well, the cost can even exceed closed source. You're better off just handing it to a token factory. And so I literally write, this is crazy. This implies that literally in the value chain, engineers are too retarded to figure out how to optimize a 41 cents model over a $50 model per million output tokens. I think that's offensive to engineers. Like, I think every engineer watching this is like, bro, I could optimize the crap out of this for these cost savings. So I thought that was a little bit of like, again, a rose-colored glasses argument. And I'm like, man, these are the people who are going viral for shilling the hardware cycle. And they're rightfully arguing that all these open source models, they're not really creating a lot of revenue. But that's a red flag. Look at this. They literally write, break down China's open source revenue. $1 billion here, 1.2 billion here, 500 million here, 300 million here. You barely get to 10 billion. Okay, that's a problem. If you combine all of the open source and you're barely getting to $10 billion with open source of revenue, how are you getting 65 billion at Claude? Well, it's because Claude just had its Claude co-work moment, and there's an explosion for this, and these models are really just getting started. The thesis or their argument is that, oh, well, obviously this must be a lot better, and therefore this is going to keep growing at this rate. My take is this ends up surpassing this and crushing this growth rate. Obviously, two different arguments. Kind of have to figure out which side you're on, but you could see some of the underlying assumptions that they make that, oh, well, you can't optimize open source as well. The fact that you would write off open source as, well, if you don't optimize it well, you're going to spend just as much as you would on the closed source, blows my mind. Maybe I'm misunderstanding the argument here, but I think that's a crazy blind bull thesis. Okay, and I don't want to sound like overly bearish here. I think this is like overly bullish. We have to kind of bring it back to reality a little bit. Now, here's another one they make a mistake on. They make this comparison between MediaTek, which back in the day offered less expensive chips compared to Qualcomm's Snapdragon product. And MediaTek, the Taiwanese play, they actually did a good job at affecting Qualcomm's margins. But they make the argument that Qualcomm was still able to stay ahead and make good money against MediaTek for years. And that they had the Snapdragon products, one for the higher end, one for the lower price band, and Qualcomm was able to do well, and so therefore the more open source or cheaper style of MediaTek, if you will, doesn't matter. Therefore, open source doesn't matter for AI either. But wait a second. There's some major differences here. MediaTek's chips were 30 to 50% cheaper than Qualcomm. The Chinese open weight models are 100x cheaper than the Frontiers. That's a huge cost difference. We're not talking about, a little at the margin 30 to 50% difference on a cellular chip. We're talking about 100x difference. That's not comparable. The second thing is, after you buy hardware on a phone, like you put in the Snapdragon processor for your cellular data, you can't swap it out. I mean, maybe you can, but not easily. Like, you're not going to go in there and swap this out to a different, Snapdragon-style chip. you're going to buy a new phone. Tokens you can swap out. I can just plug in a different model like Palantir does. Hey, which model do we want to use? Let's just open router it, right? And then Qualcomm also had a patent moat. So I think the guy's got, you know, like every scenario that he's come up with so far in this piece is the rose-colored glasses on hardware. And I'm not trying to sound bearish on hardware, but if I look at the bull argument, I'm like, that's stupid. Sorry, like that is just too bullish. And if those are the people pumping up the prices of these stocks, then this is a bubble. That's not good. But anyway, so what else? They argue, therefore, at least through 2027 and 2028, we're not in a bubble. Okay, maybe. You know, I mean, I'm bullish in the near term. I think we'll get through Jackson Hole, and we could be optimistic in the near term. You know, you could simultaneously think that hardware or stocks can do well over the next 6 to 12 months, and also think that it's all going to come crashing down into a glorious bubble pop, you know, in 2 to 5 years, right? So that's sort of where my view is. But these arguments, I think, are worth deconstructing because there are a lot of oopsie-doopsies in this that if somebody just AI summarizes this whole document, they're going to miss massive nuance. And maybe I got some of, you know, maybe I'm too extreme on my counter-arguments. I don't think I am. I think my counter-arguments are reasonable. But there's some fatal flaws in this bull narrative. And anybody who's investing around does the compute still math out should really understand arguments on both sides of this and then have a thesis to build on top of that. So that's my take. Okay, now let's see here. We've got Jackson Hole coming up in 5 minutes, supposedly, if they're going to be on time. So we'll be covering that in just a moment. I do want to make a quick note here. There we go. Quick note, today, coupon code JHOLE does expire for the Meet Kevin membership, which gets you all 9 courses, every alpha report, every private live stream we do, every trade alert, what we're buying long-term, you name it, over at meetkevin.com. Use that coupon code JHOLE expiring today. Tax professionals say it could be a tax write-off. And if you want to bundle up, today will be the last day to get lifetime access to the Reinvest Homes membership. We're changing this to a monthly and annual subscription model. If you lock in lifetime, you will lock it in forever. Okay, good. If you're a course member, by the way, and you want to bundle the Homes AI, email us at staff@meetkevin.com, and we'll hook you up with a special bundle code, so that way you could get that lifetime access to the Homes AI. Okay, so with all that out of the way, what do we got over here on NVIDIA? What the heck, man? Still can't hold the line. Again, could be nervousness coming up to J-hole. I've actually got SpaceX popping over 140 here. That's neat. You know, it has a really good floor at about 133. SpaceX consistently bounces at roughly 133. So that's if you don't have that line, rise the 133 line. Obviously, the low on our fib there is the 104, but it's that first retracement of 133 that gets people pretty excited. Affirm was up like 15% after the bell, and you could see Affirm is also having a little bit of a struggle bus to keep some of those enthusiastic gains up. It could just be like, who buys in the minutes before Kevin Warsh comes out, right? Like, you're going to want to see him open his mouth. You're going to want to get the transcript. If we get a transcript, we'll run through it really fast. You know, we'll be able to tell you what's being said really freaking fast, which will be juicy. So we'll take a look at that. I've got all my windows up to make sure that we are tracking it closely. Technically, the Warsh event is supposed to start in 2 minutes. We shall see if it actually is timely, given that they probably at the event run on, you know, event time frames rather than Warsh time frames and Fed time frames. They don't necessarily have to be on time. We'll see. Palantir 185, one heck of a rocket ship since we got some exposure to this down in even the 118 range. Little disappointed it ran so fast. The technical analysis really said it was going to, but I thought there was still some more time. So I wish I bought more, as is usual. But still happy we got it, and it's really nicely up. I actually think there's still more upside in it, though. This is, somebody left a comment yesterday, like, Kevin, is Palantir now too overpriced? Maybe what we'll do is we'll do a full breakdown on Palantir. But people have to remember just the moat this company has. They have a line out the door of people who want this product. Downside risk is because they have a line out the door, people could get frustrated and sort of try to create their own Palantir-like replacements. I don't think that's necessarily an easy task to pull off, but it can be pulled off. To at least some extent. Salesforce, let's take a look at Salesforce here. Salesforce is still booming today. CrowdStrike for cyber is giving back a little bit of their 22% gains yesterday. And if I look at Intuit, oh, hold on, the Warsh numbers. Okay, Fed must be confident underlying inflation is moving to objective. Otherwise, we have work to do. That sounds bullish. Yeah, here it is. Stupid. I'll just read it out. My screen isn't showing it. Warsh consumer spending is healthy, labor markets are stable, must be confident underlying inflation is moving to our objective, or we have work to do. Numbers are more, here, he's coming.
It was 25 years ago that we were colleagues. It's an honor to share the stage with you. It's great to be back here in the Valley again.
Inflation expectations look durable until they don't, must be closely minded.
And for my first 100 days, which
expectations look stable.
I've been looking forward to this weekend. And before I go further, I want to thank Jeff Schmidt and his team for the incredible hospitality. Everybody here is in debt to you and to your colleagues here at the Federal Reserve Bank of Kansas City. Jeff, our thanks to you and your team.
Hey, while he's doing introductions, just look at this really quick. You could literally get this on the Meet Kevin app. You download the Meet Kevin app. All of what was just said in the transcript fully published there at 6:59. Go get it. It's in the Meet Kevin app. It's free. You could also get it on desktop by going to app.meetkevin.com after you download the Meet Kevin app and sign up.
Cone with 2 words: I survived. These steely marathon death marches revealed a sign of dawn that I was not ready for. But there's another kind of hike. This one was with former chairman Ben Bernanke, another dear old colleague. With Ben, it was a much more leisurely pace.
Bro, this guy's going to have a really big, long, boring intro. We're going to listen to it all. I just want to point out that so far, my initial readout on this summary is that, him saying hard-pressed to describe financial conditions are restrictive and we're going to have work to do, it's him acknowledging that we might have to raise rates in the future, but I don't think it's close. I think he's kicking the can down the road to December with this.
In our time. For me, it feels like the right place and the right audience for a real engagement with the ideas that matter most. Innovation, as Kristen mentioned, is the conference theme. And I believe the public and the markets understand that innovations in the conduct of Fed policy will help deliver price stability alongside full employment. So here's a quick overview of what I'll cover in my remarks this morning. You can call it an outline, you can call it a trail map, but please just don't call it forward guidance. First, I'll touch on a few of the longer-term questions we're asking at the Fed about the latest general-purpose technology, AI, and where it might take the economy. Then I'll reflect a bit on the practice of forward guidance and the interaction between the central bank and financial markets. Next, I'll present some of the key principles that I believe should guide the conduct of monetary policy. And finally, I'll give you my assessment of what's happening in the economy. So first, I think we should try to prepare a bit for future policy conjunctures. With the unchanging picture of the Tetons as our backdrop, we are here to survey an economic landscape that is anything but static. It wasn't so long ago, including in rooms like this, in the run-up to the crisis of 2008 and over the decade that followed, when economists and policymakers were speaking of secular stagnation, speaking of a global savings glut, It was a widely held view that an excess of capital would sit on the sidelines for a very long, long time because there just wouldn't be enough compelling investment opportunities. All the good stuff, you'll recall, had been invented, so growth would be low and slow. Well, times sure have changed. We've come to a hinge point in history, to borrow a phrase, a framing from my former mentor, George Shultz. To cite the clearest example, progress in AI, the 80-year-old name for the newest technology, has been faster even than its evangelists predicted just a couple of years ago. The potential for substantially higher growth is on the rise. Ever-expanding pools of capital pouring into AI-related infrastructure of all sorts. A kind of super Moore's law seems to be playing out. Scaling laws, too, are changing both the method and speed of innovation. Capital and labor have combined to create large language models at the heart of AI. Users buy tokens to gain access to these models. Reports put annualized token sales for the 2 leading labs alone at more than $100 billion, an increase of 500% from just 12 months ago. We at the Fed, we watch all this attentively. We recognize that AI is a new variable, potentially a new factor of production that will have consequences both for the economy and for the conduct of monetary policy. It opens up some major lines of inquiry. Will the application of AI cause a significant sustained rise in productivity across the economy? If so, when? Will token usage be complementary or competitive to labor? Will the next generation of AI models demand even greater capital intensity too? Or will the models themselves help devise a capital-light solution? Among the other yet unknowns is the resulting market structure. Who gets to make the money? It's not obvious where the returns on capital will land or on what timescale. Early on, how much of the surplus goes to owners of scarce assets, the AI labs or chip makers or energy producers or cloud providers? Over time, how much of that value accrues to businesses and consumers? And importantly, what are the implications for workers and for the employment side of the Fed's mandate?
Quick note, he does end up saying later in a speech that inflation better than expected. Don't tell me underlying trends have changed. Good majority decided it was a wiser course to wait. In my opinion, this is bullish kicking the can down the road, and he's getting into a long speech here, it sounds like.
Access to the best models, those at the frontier. Will token prices for older models fall to the level of their marginal cost? Well, we'll be thinking through these matters with the help of a task force on productivity and jobs. My early check-ins with the leaders of that task force and the rest have been very encouraging. To be clear, though, their recommendations will come later and have no bearing on decisions we make in the current policy conjuncture. But I believe that for future policy challenges, this intellectual investment today will leave us much better prepared for tomorrow. Next, let me say a word about forward guidance and its substitutes. As our task forces go about their work, as you might know, I'm not waiting to introduce innovations at the Fed to help make us fit for purpose. To highlight one example, I've set out to change the form and function of the Fed chairman's so-called forward guidance. You might know about my longtime discomfort with early pronouncements of future policy decisions. I much prefer another path, and now we'll make the case for it. Transparency in communications about future policy decisions is not an end unto itself. Communications must be in service to the Fed's paramount responsibility. And what is that? That's getting policy right. Forward guidance as a regular practice was adopted by my colleagues and me during the global financial crisis. It was essential at the time, and we introduced it with much fanfare. But as with other legacies of crises past, I believe the practice has outstayed its welcome. In normal times, the role of forward guidance should be limited and circumscribed. Otherwise, it risks creating ambiguity in the name of clarity.
So he's calling now normal times, which is dovish.
Operations and overcommitting to future decisions can lead markets, businesses, and households astray. And I believe when policymakers make quasi-commitments on interest rates throughout the cycle, we inhibit our own freedom to make the right calls when it's time to decide. To get policy right, we also need to get the relationship right between the central bank and financial markets. The Fed needs clear market signals, as unfiltered as possible, from market internals, from the level and change in asset prices across sectors, the prices and trading volumes of Treasury securities, the foreign exchange value of the dollar, the cost and availability of credit, a broad set of commodity prices. These and other indicators should inform the Fed's near-term outlook on economic activity and inflation throughout the business cycle. They should also reveal the state of broader financial conditions and the risks and uncertainties of the financial cycle. At the same time, market participants themselves should be tracking real information about the real economy. They should draw their own conclusions, form their own expectations on things like output and employment and inflation, and they too should stay sharply attuned to risks. In my view, the Fed should be humble and never naive. The Fed plays an essential role in the economy and markets. Our tools are powerful. We determine the path of short-term interest rates, and market participants will always try to anticipate what we will do next. But we should not indulge a regime in which market participants are looking primarily to the Fed for their next trade. The economic literature has long described the distorting effects, what it called the Hall of Mirrors problem. If markets rely materially on the Fed's guidance and the Fed relies on market prices, we're more likely to be blinded to new developments, more likely to be caught unprepared, and more likely to commit errors in policymaking. Now, perversely, market participants are unlikely to bear the biggest costs of the Hall of Mirrors problem. The most serious harm is likely to befall those without any financial assets. If the Fed gets inflation wrong and judges the economy wrong, who gets the worst of it? Not the financial high flyers. Hardworking Americans are the ones left to deal with inflation that's too high or jobs that suddenly appear less secure. So, if forward guidance is ill-suited to normal times, how about the new Fed chief commits at a meeting just like this to some explicit reaction function? Surely he could tell us his interest rate path if, say, the data were to come in hot or cold. Well, I wish our understanding of the economy were so precise as to provide a mechanical, tried and true answer, that some simple function, like a Taylor rule, could be rigorously relied upon. But our knowledge just does not extend that far.
So we're gonna kick the can down the road until the task forces come.
Other factors most relevant to the proper conduct of monetary policy, they change over time. Providing forecasts to illustrate the Fed's reaction function works better in theory than in practice. Better in the lab than in the field.
Somebody says, did he use Sleep GPT to write this, bro?
Forward guidance in 2021, to cite just one example, might well have slowed the policy response to high inflation. In my term as chairman, my colleagues and I will endeavor to construct more reliable models, more robust rules, and we'll do this knowing that accuracy in forecasting is still just an aspiration. With so much changing so fast in our geopolitics, global supply chains, technology, it's wise to be modest about what we can and cannot know as we sit here today. In the same spirit, we should receive the full range of ideas on matters that may inform the Fed's monetary policy discussions. If the aim is optimal decision-making, and it should be, we should not crowd out views on the economy. How then to chart a better path to policy? In the balance of my remarks, I will share with you some key principles that guide my thinking on the appropriate conduct of monetary policy. And then I'll offer my promised assessment of the economy. So let's turn first to principles. First, I've noticed in this line of work, yesterday's news has a way of getting mistaken for what's happening right now. The challenge is to know the difference. In other words, we must interrogate reality. Make sure we're not setting forward-looking policy based on stale or inaccurate data. Nor should we rely on isolated data points. Trends matter most. The Fed's a decision-making agency. We make choices amid uncertainty, and the data upon which we draw must be relevant, contemporaneous, accurate, and as actionable as possible. Second principle. The Fed's actions are intended to ensure that the aggregate demand side of the economy is broadly consistent with aggregate supply. However, all we observe directly is activity. We never see and can only infer what's really happening on the supply side. Hence, evaluating the current and expected balance between aggregate supply and aggregate demand is imprecise. Third principle, there should be no misunderstanding. The Fed's price stability objective of 2%, as measured by the PCE price index, is a firm, fixed target. Let me be equally clear about another aspect of this objective. Price stability is not self-executing, nor is inflation necessarily mean reverting. It's the Fed's job to deliver stable prices, no excuses.
That's not
Fourth
good.
principle.
That's bearish.
The Fed also bears responsibility for maximum employment. Achieving both sides of our mandate over the medium term is not an either-or proposition. I do not believe the Fed's dual mandate works at cross purposes. After all, high inflation itself is very harmful to economic prosperity. Fifth principle, short-term interest rates are the predominant tool to achieve the dual mandate. Unconventional policies to spur economic activity may suit genuine crises, of which we all have much experience, but they should otherwise be used sparingly, if at all. Sixth, money matters. I know it's not fashionable these days, but my view is that money has something important to do with monetary policy. We should pay attention to money created by the central bank and money that comes from the banking and financial system. It's true that financial innovations, the subject of this conference, and other factors alter the mechanics that link the monetary base, the velocity of money, and the broader economy. But that is scarcely a reason to ignore the ultimate effects of money on financial conditions and prices. Finally, a quieter Fed, a more purposeful Fed in its communications, is better able to meet its objectives. And we can be held accountable for delivering on our remit, the only true test of our credibility. To borrow a line from General Chuck Yeager, at the moment of truth, there are either reasons or results. So having heard a little bit about AI and general purpose technologies, having heard a little bit about the next policy conjuncture, a little bit on principles, let's turn to the economy today. Given those principles, how do I read the economy? What's really going on outside the window?
That section was bearish. Okay, he basically says our credibility is on the line. Results matter, not reasons. short-term interest rates are the primary tool. Price stability is not self-executing, and inflation is not necessarily mean reverting. All that was bearish.
Period right ahead of us. Now, you may have read in the July minutes the unanimous view of the FOMC. Labor markets were stable, output solid, but inflation remained too high. A good majority of my colleagues and I thought the wiser course was to await new information in the intermeeting period, especially given possible developments in supply chains, investment flows, and geopolitics, before deciding whether a change in interest rate policy was advisable. And we expressed our joint readiness to act as circumstances require. For my part today, as we sit here, I'm impressed by the overall performance of the economy, which appears to have strengthened. One indicator of strength is how well an economy holds up under stress, how well it holds up under shocks. On that score, both Main Street and Wall Street have been remarkably resilient. Several other observations. Business CapEx is rising rapidly. The 4-quarter change in investment in equipment and intangibles has been around 9%, its highest growth rate since 2021. And more than half of the CapEx growth can likely be ascribed to the build-out related to AI. What about profits? For the firms in the S&P, profits have grown more than 20% over the past year alone. Profit margins are quite elevated relative to history. Overall equity and market volatility, quite low. We're staying keenly focused on market internals, watching performance across sectors. Expectations for both growth in CapEx and corporate earnings are running quite high. I continue to watch the change in the growth rates, the second derivative. The follow-on effects on asset prices, business confidence, consumer incomes and spending are equally important to gauge. Credit spreads
Second derivative sounds like he's been listening to me.
are near the low end of their historical averages. And issue volumes this year, quite strong. Looking beyond fixed income markets to the banking business. In the July so-called SLOOS survey, banks tell us that standards for C&I loans are on the easier end of their historical ranges. It helps explain their growth that we've seen this year in these loans. In my view, credit and loan markets are showing few signs of policy restraint. Now, certain sectors, like housing and agriculture, are showing strains. But on balance, I would be hard-pressed to describe broad financial conditions as restrictive. Real consumer spending has been healthy despite these shocks, increasing more than 2% over the past 4 quarters. If you combine consumption with the brisk investment we talked about earlier, private domestic financial purchases have also risen. These purchases have increased at a pace of nearly 3% or so far this year. That's a measure that typically carries more signal than GDP. The trend here, too, positive. So on the employment side of the Fed's dual mandate, our country's doing well. Labor markets are quite stable. The jobless rate at 4.1% remains low by historical standards and hasn't changed much in a couple of years. Unemployment claims on a 4-week moving average, an empirically robust real-time indicator, are near their lowest level in decades.
Lagging.
In my view, the relatively low turnover in today's labor market is partly a result of the significant rematching between employers and employees that happened in the post-pandemic environment. But when labor supply is barely growing, monthly job gains are naturally going to run low. There are always areas of concerns in the labor market. For example, among recent graduates. In general, though, people who want to work, by and large, are holding or finding jobs.
Shout out to the ton of you signing up for the Alpha membership at meetkevin.com. Thank you, by the way. We love you. We'll take good care of you. Coupon expires today. This is J-Hole.
Are broadly consistent with full employment. But on the price stability side of our mandate, the numbers are more concerning. The Fed's preferred measure of inflation, the one I talked about earlier, the 12-month change in the PC price index stands at 3 0.7%, with a 6-month change a little above 4. The comparable measures from the CPI index are also elevated, as are core measures both of PCE and CPI inflation. Now, none of these measures are perfect, but they all tell a similar story. Inflation is running above our 2% target. So the Fed's predominant focus right now should be on prices. So what's our job? The job for policymakers is to capture underlying trend inflation. Easier said than done. We want to gauge whether underlying inflation is rising, falling, or seems to be stuck in place. We also want to understand not just the direction of travel, but the speed. Each of these broad inflation measures have fallen significantly from their highs of a few years ago, but progress over the last couple of years has been more modest. And while this summer's PCE and CPI readings were better than expected, they do not tell me that underlying trends have meaningfully improved. The data also show moderate wage growth. But in my view, in tracking underlying inflation, wage growth has not proven a reliable indicator of future inflation for a very long time. So to try to gauge underlying inflation, I want to tell you about a couple things I've always looked to. I find it instructive to disaggregate the 199 individual components of the PC price measure.
Oh my God.
Over the last 12 months, 54% of goods and services in this basket showed price increases above 3%. This is well below the post-pandemic highs of about 77%, but it remains well above the level of 32% in a couple of the decades that preceded the pandemic. Looking over just the last 6 months, the conclusion is similar. 49% of goods and services in the PC basket showed price increases above 3%. Again, this is well below the post-pandemic highs, but still elevated, quite elevated. The recent rise in overall commodity prices also bears watching. What we need to judge is whether the trends we see indicate upside inflation risks. Now, it matters, too, whether the inflation readings of the past 5 years have seeped into expectations. The good news is that measures of inflation expectations in the medium term, by and large, look stable. And inflation compensation measures from the swaps market send a strong and similar message. Especially in light of recent developments, it's a credit to the Fed as an institution, consistent with the best of the Fed's traditions, that market prices show confidence that we will deliver price stability. And I can assure you, they're right. The thing about market measures of inflation expectations in economic history, I know some economic historians in the audience, is they all tend to look really strong and durable until they don't.
Yeah, we just jacked up to a 50-50 chance of a rate hike in September now. This is going long and bearish.
They must be closely minded. And it's the Fed's job to make sure that inflation expectations do not get unanchored.
Great.
Now, there is one signal nobody can miss. The responsibility for 65 months of sustained elevated inflation
Joe Biden
sits squarely with the central bank. And that's where it belongs. So here is my standard. We must be confident that underlying inflation is moving to our objective, clearly and at sufficient speed. Otherwise, we have work to do. That's our job, that's our mandate, and that's our charge to keep. So I've covered quite a bit of ground in the last 25 minutes or so. Let me see if I can conclude this way. I stand here today committed to a discipline, not a decision. My Fed colleagues and I are hardly the first to hold these positions in a time of great consequence. We are determined to redeem the time by doing our very best work. For those of you that know us, you'll know the following is true. We take our responsibility seriously, with humility and with resolve. We know so much depends on the choices we make. Sound monetary policy helps households and businesses to prosper. When carried out effectively, it broadens and deepens the momentum of our economy and helps to secure America's leadership in the world. And I know that our country needs us to think carefully and act wisely, perhaps now more than ever. It's a tremendous honor to serve once again at the Federal Reserve. I'm truly grateful for the encouragement, good counsel, and the warm reception I've received in my first 100 days from my colleagues. I'm also honored and grateful for the views that I've gotten, solicited and unsolicited, from so many of you in this room. For that, and for your kind attention this morning, I say thank you. Let's get on with the rest of the program.
That is the Fed Chair, Kevin Warsh,
I
expanding.
didn't like that. That was not ideal. That was, wow, I literally have Bloomberg Intelligence here, just wrote a note, and they're saying, we think Kevin Warsh is dogmatically setting up for a policy mistake. There's one signal nobody can miss. The responsibility of 65 months of sustained elevated inflation sits squarely with the central bank, and that's where it belongs. Yeah, that is a really good line. So let me see. I'm just looking at some other reactions here because I wrote that down as well, but that's even more blunt to say. Like that's a pretty clear signal. Must be confident that underlying inflation is moving to objective with sufficient speed. That's our job. That's our mandate. Yeah. That's also not ideal. Let's write that, drop that down right here. Okay. These notes, by the way, are all on the Meet Kevin app. We're going to summarize this in just a moment, but you can see all of the notes that I'm taking on your Meet Kevin app, which you can see on your phone, Apple or Android. It's totally for free, totally free. Or you can see it at app.meetkevin.com. And then, let's see here. If forward guidance is ill-suited to normal times, then how about the new Fed chair commits at the very least to an explicit reaction function? Surely he should tell us the interest rate path if the data were to come in hot or cold. This is just yapping. Warsh's speech is very much in line with his recent press conference and congressional testimony for rate markets. It's being correctly taken as hawkish. Knee-jerk reaction suggests the twist to flattening that might occur if the Fed does actually hike at some point in the near term. Yeah, it doesn't necessarily have to be before the election. Price stability is not self-executing, nor is inflation mean reverting. I wrote that down too. I actually went back in the background and listened to that a second time because I'm like, ooh, that was not good. Unconventional policies to spur economic activity may suit genuine crises, but should otherwise be used sparingly, if at all. Okay, fine. Warsh seems to be digging in dogmatically against Fed communications. We think he's setting up for policy mistakes. I agree. Let's see how this settles. But each time we now hear from Warsh, the reactions become muted unless he starts to corral the FOMC into an actual hiking cycle. If the talk remains tough but tightening is skipped at upcoming meetings, then it's more of the same. Yeah, I mean, that's fair. So, like, in fairness, this has been sort of his... That's actually a really good point. So, in fairness, in June and July, he talked tough about rates, but then did nothing. So maybe this is more of the same. That's a good point. Like, you get the more of the same talking, but, is he actually going to put the pants on? He sounds like he's going to put the pants on. And hence, now we have this 50-50 shot of a rate hike on September 16th. Let's see, sentiment models. So Warsh's speech was hawkish compared to Powell's remarks the past few years, but consistent with prior. So a hawkish speech, but consistent with prior. I agree with that because it's very similar to how he talks at the Fed. Warsh, let's see here, 5-year forward. bond markets anticipation, few measures of this all look reasonably well behaved. That's fair. Yeah, you could look at the 5-year inflation break-evens, or you could look at the 5-year, which is, what we think inflation will be 5 years out, 5 years from there. Whatever. Okay, so let's try to put these pieces of the puzzle together, because that was a lot to digest, but we'll go through it, and we'll try to make it as clear and simple as possible. So let's do a little bit of a summary here. And yeah, all right, let's do it. Okay. There was a lot to digest in Kevin Warsh's speech that just happened, and it's not too dissimilar from what we've seen in June and July, where, he wants to talk really tough and act like he's putting the pants on, but markets might be discounting to some extent whether or not he's actually going to have the balls to put the pants on and hike rates, especially since the next 2 Fed meetings are right before the election. So, what did we get out of the speech? First of all, we got markets moved the odds of a rate hike to 50% from about 32%, which suggests that the speech was received as more hawkish than not. Although that kind of aligns with how Kevin Warsh sounded in June and July, where he talks about how important Fed credibility is, and then, nothing actually really changes. They just sort of defer to the task forces. So his talk today was tough, which is probably why we got those increased expectations of a rate hike. But again, I have this mindset that the odds of this guy actually hiking before we end up getting the elections, the next 2 Fed meetings are before elections, midterms, pretty low, but we'll see. A quick note before we get into the actual details of what was said, because there were some real red flags in here. We do have coupon code JHOLE in honor of today. Jackson Hole expiring today. The Meet Kevin membership, all 9 courses, every trade alert, every private live stream, every alpha report. You get lifetime access to it. And tax professionals say it could be a tax write-off. And on top of that, today is a very special day because the Homes AI lifetime subscription access is going away for sign-up. Which means if you sign up today, you still lock in lifetime access, but if you don't, it will be going to a monthly and annual subscription model. So I think this is a wedge deal right here. If you're a course member, you could actually bundle up and lock this in. Just email us at staff@meetkevin.com. Let's hit the summary now. So first, the most bearish segment out of what Kevin Warsh said, we'll start there, had to do with his price stability talk. He says we have to look at underlying trends, not just recent data. And so what does he say about recent data? He says, hey, the summer, we had some good numbers, but the summer readings, quote, do not tell me that trends have meaningfully improved. That's bearish. He says, progress has been made over the last 2 years, but not fast enough. That the 6-month PCE measures sit over 4%. And even though the measures aren't perfect, he says, the story is clear. Prices are above target. It's not good. So far, this is all hawking. Then he says, let's look at the 199 components in PCE. And I'm like, long, boring speech. Okay, here we go. And so what does he tell us? He tells us that 54% of PCE components over the last 12 months sit above 3%. And in the last 6 months, 49% of them sit above 3%. Commodity price trends, also not great. So all of those components relatively bearish on pricing. He also says there's one signal no one can miss. Or I'm sorry, he didn't use those words. The one signal that nobody can miss is that this, quote, the responsibility for 65 months of sustained elevated inflation sits squarely with the central bank. And that's where it belongs. Again, really tough talk. He's really trying to hawk, right? Is he actually going to have the balls to do anything? Nobody really knows yet. But he talked so tough that you actually ended up getting the folks over, and I tweeted this. You could follow me on X if you don't yet already at RealMeKevin, but I tweeted this. The folks at Bloomberg Intelligence literally said this guy is sounding so dogmatically like he's convinced he wants to set up a policy mistake. That a policy mistake is a really loaded statement. A policy mistake refers to what we saw in the dot-com bubble, where Alan Greenspan ended up hiking rates and marking the top of the bubble. So it's sort of like he kind of like popped the dot-com bubble by jacking up rates at kind of a sensitive time. That then was considered a policy mistake. We haven't really heard the phrase policy mistake. Obviously, transitory, you could argue, was a mistake. But we really haven't heard a reference to a real Fed policy mistake since then. So, little on the hawkish side, for sure. Let's take a quick sip here and keep going. Gotta get that coffee. Anyway, he then talks about how discipline matters. That we have to be confident that underlying inflation is moving to objective at a clear and sufficient speed. Otherwise, we have work to do. That's our job. That's our mandate. Okay, not great. So all of that relatively hawkish. This morning in the course member live stream, we actually did a breakdown in our alpha report where, in our alpha reports, you already know this, we set up short-term trades, medium-term trades, and long-term trades, whatever. Do all of that, bull, bear, scale, everything. What we set up was that if we have a long speech on credibility, it's bearish. If we have a short speech on task force deferral, it would be bullish. Unfortunately, we got a long speech on credibility. So that's, I think, why the rate markets are reacting, which, again, not great. But then another component beyond this price stability segment that, unfortunately, in my opinion, is quite hawkish, is this component on the underlying economy. And I'm also just taking a quick peek at yields. I can see the 10-year is almost back up to 4.7 after this speech. Also just not ideal. But his talk about the economy, I think, is pretty blunt about how he believes, or in my opinion, how he's setting up for an eventual rate hike. Now, again, do I think it's going to happen before the election? No, but the odds of a December rate hike just skyrocketed today. So we could still be good in the short term, but man, December just got dirty. Man, no wonder Jay's reaction, my son Jay, had a little bit of a concerning reaction about J-Hole. He's like, Dad, really? J-Hole is the coupon code? Anyway, so, okay, what did he say about the economy? How well is the economy holding up under stress? Remarkably resilient. This is a reference to geopolitical and tariffs, obviously. How's business CapEx? Rapidly rising, around 9%, highest growth rate since 2021. Half of that likely due to AI. I mean, that's bullish stocks, but that's hawkish Fed. Profits? S&P profit growth, 20% on profits. Margins are elevated relative to history. That's hawkish. Volatility, relatively low. I want to be clear, volatility, the way they usually measure this is they usually just end up looking at the VIX, the CBOE Dow Jones volatility measure. And so if you zoom out on the VIX, you can see we've got this lower line right here at 1516. We're actually below that low. So yes, volatility is low. He's right about that. Then he says change in growth rates. We're paying attention to them. Those second derivatives, those are going up. The SLUS survey, with the exception of token usage, the second derivatives down that and memory prices are turning negative, but that's really a topic for a different video. SLUS survey, which is the senior loan officer survey, we're at the easy end of historical ranges of lending looseness. In other words, it's easier to get loans today than ever before. Housing and agricultural sectors are showing stress, but it's hard to say the economy is restrictive, he says. Quick little sidebar, like my take, of course it's a mess, my take on where kind of we sit with the stock market versus housing. I like just reiterating this because people always wonder, they're like, Kevin, how could you be bullish on the stock market in the near term, but then you're also so bullish on real estate? Well, in my opinion, you answer that with positioning, right? So if the stock market, this is sort of I hope I'm not too pedantic here, but if the stock market, in my opinion, is closer to the top, right, my take, and this is sort of my 10-year thesis on my 10-year chart, then I think real estate is pretty well over here, closer to the bottom. Some markets might still be here on real estate. But the point is, real estate is here probably, and stocks are probably up in this sort of range right there. And I think that's useful to know because you could sort of evaluate how do you want to be positioned. How much risk do you really want on the table? Anyway, He says the labor market is stable, low jobless rate, hasn't changed much, basically declares victory on the labor market, says we're doing well there, and therefore the primary focus is policy interest rates. Because remember, he made it clear that the primary mechanism for dealing with inflation, in his opinion, is short-term policy rates. Not great. And he also says, this is another interesting note here, he says, we have to be confident we're moving underlying inflation to 2% at a sufficient speed. So this was really a speech about credibility and the speed of getting inflation down. Again, is he actually going to put the pants on before the election? I don't know. But he really is setting up some hawking here. He argues that we're hard-pressed to describe financial conditions as restrictive. That's hawkish. Says we must be confident underlying inflation is moving towards objective, and he's not confident in that, he said. He did talk about how artificial intelligence could affect the market, which is bullish and dovish, but that was really a setup for we kind of have to measure that with our task forces and see what ends up happening, kind of kick the can down the road on that. So there were some comments that were relatively bullish, such as he suggests the markets suggest we will deliver price stability. Okay, that gives some confidence that like, okay, maybe you don't have to act right away. Like people are still confident as long as you maintain that confidence, right? So we're not necessarily at the greatest urgency for a hike. And he says for future policy challenges, task forces will prepare us. Okay, a little bit of a kick the can down the road. Forward guidance should be for limited in normal times. He's basically calling now a normal time useful because it suggests that we're not at a really abnormal time. So I think really, if you put together all of what we got here, we have this balance of this guy trying to tell everybody that he's a bad A. He's a baddie and he's going to do it if he has to. Do I really think this jacks up the odds of a September odds? Markets do, yes. Me, no. I think politically there's no way he does this before the election. Especially since I think he's a puppet. That said, this tough talk is going to become meaningless unless he actually has the balls to do something that really does meaningfully increase the odds of a December rate hike. I would almost make the argument they're going to start a rate hike cycle this year. It's not going to be before the election, but it's coming. Now, another little thing to note is that a lot of the notes on his initial sort of summary statement that they published, they came through immediately on the Alpha Wire. So I do want to shout that out. If you don't have that yet, you could get this for free in the Meet Kevin app. The way it works is you just download the Meet Kevin app in the Apple or Android App Store. Okay, there's a lot of data we put in there. There's a lot of good information we put in there. We get a community tab. You can ask questions in. Sometimes I'll make video replies to those. We'll do some of them today as well. We've got over here, though, all this information coming out instantaneously, and you're not distracted by what you get on, like, maybe, Instagram or X or whatever. It's just sort of a news wire feed. So check that out. It's a cool tool. Meet Kevin app is free in the Apple and Android App Store. If you want it on desktop, after you sign up for the Meet Kevin app, then you go to desktop, you use the same login at app.meetkevin.com, and then you could also get it on desktop, which is kind of useful. Okay, good. So, overall, definitely a hawkish tone. Pretty much guarantees us a rate hike in December. September, between now and then, we're still good. That's my bottom line takeaway. So with that, obviously join us over at meetkevin.com before that coupon code expires. And that's a wrap up on what happened with the Fed. Okay, cool. Now let's listen in a little bit to what, I don't know, Liz Ann Saunders is saying and Bloomberg are saying. We'll go listen in a little bit.
My role is more to think big picture, long term, not day of kind of analysis. And I think what's the important change in the background right now, which I think is secular, is this shift away from the conditions that existed during the Great Moderation era, where you have
blah, blah, blah. Yeah, I know. Okay. So what about, I just want to take a quick look at NVIDIA. You definitely lost 227. We are going back for another test, which is good. Kevin, you still think lower mortgage rates in 2030? It's 2032. Remember, we started House Hack with a 10-year play on real estate and mortgage rates. That was the thesis of 2032. Just want to be clear about that. And the thesis is by 2032, rates will be lower than ever in the history of America. Yes, I still believe in that. I know that sounds extreme listening to, Kevin Warsh talk now, but it's actually because I think he's going to screw up. He's going to make a mistake. We end up peaking on the hardware bubble and everything goes to crap and they have to lower rates really, really low to actually enable financing and borrowing. And so, yes, my thesis remains unchanged. And I'll gladly take the L if I'm wrong. I'll say, hey, I was wrong, but I don't think I'm going to be wrong. Who knows? Maybe I'm overconfident on it. I don't think I'm going to be wrong on it. We'll see. So, and it's a bold prediction, but it's also how we're positioning with real estate. So. Putting money where the thesis is, like real money. So we believe it. Okay, let's see if the doomers have some more reactions here. Ultimately, the course will matter. September rate decision. After saying he's not happy with the latest inflation data, do not tell me any failure, unless of course that circumstances change. Yeah, I mean, whatever. We got CPI coming up on September 11th. Let's listen to some reaction over here.
The one that everybody still comes to, but the sense that the U.S. is not as safe as it might have been once upon a time, that is certainly true as well.
And your paper talks about how stablecoin could generate demand for the dollar that just increases its status as a reserve currency. Do you think that there is a tell in the fact that the dollar has weakened since Fed Chairman Kevin Warsh has taken over on May 22nd? Or do you think that that is coincidental because of some of the confusions and turmoil in global markets?
So I look beyond these short-term movements because there are macro factors and policy factors that can drive these in the short run. But the paper that I am presenting here is more than just about stablecoins. Stablecoins already exist, so they are the sort of leading edge of financial innovation. But the key aspect of financial innovation is that it is going to reduce frictions to cross-border asset trade. It's going to make it much easier for firms to raise money in capital markets worldwide. It's going to make it
not really doing a good disco. And why did it say soon? Is that like way behind?
Worldwide, and I mentioned earlier that private investors are the ones who are really acting very forcefully right now. If you make it easier for them to get foreign assets, what assets are they going to be looking to? It turns out the answer seems to be dollar assets. So it's in that sense that this combination of financial market depth in the U.S. and financial innovation that reduces frictions to cross-border asset trade.
The Bloomberg feed is funky over there. We'll go over here.
Yield relationship to inflation, the yield relationship to nominal growth is not a bad thing. If it were to become disorderly and speed were to accelerate, then I think you probably see that as a volatility driver for the market. But the move up to still sub 5% on the 10-year, I think the economy can handle that. And I think it's obvious that the equity market has been able to handle that.
Private sector can handle it. We'll see what it means for government debt burden and all the rest. That's another conversation. Liz Ann, thanks so much. Appreciate it.
Nice to see you.
Liz Ann Saunders.
After the break, how the options market is reacting to the chairman's speech. We'll get to see.
Yeah, we know. 50-50 chance of rate hike. Yeah. Okay, so I don't know, man. People aren't ready for rate hikes. You get back to rate hikes? Another rate hike cycle? Man. I don't know, man. I didn't like a long speech on credibility. So, we shall see. How are we doing over here in the market, though? So, we got NVIDIA loses 227 again. Bad for hardware rally. Affirm is bleeding out. It was up 15%. Now it's only up 7%. Ulta Beauty is down 5% after earnings. Workday is actually recovering nicely on sort of bottoming out on the software trade here. Overall software trades bottoming out. Autodesk, still also bottoming out, although it's down after earnings. Intuit is has fully recovered its post-earnings drop. Let me go to unaveraged for a moment. So earnings were here. We were at 356 to 367. I guess we're still a little bit below. Still a little bit below pre-earnings there on Intuit, but also off the bottom. I've got AMD still hanging up here by 452. That continues to be a bounce spot for people to trade off of or buy. Excuse me. Bitcoin once, oh my gosh, look at the double rejection on my line. And that's not even a flat line, that's a diagonal. You know, look at the line on Bitcoin right here. That's a diagonal growth trend. And that's a, what? Now we've got losses over here in May and a double rejection here recently, essentially. Not great. What is this? Christopher Hodge, U.S. economist, says, this is appropriately hawkish, and we have been saying for a while that anything below a 40% odds of a hike in September is too low. Well, I mean, okay, fine then. I guess now we're at 50%. You got what you wanted. Okay. 50-50 coin toss for September. Do you imagine how pissed Trump would be if he actually raised rates before the election? Dude, Trump will lose his SH9T. A ton will hinge on the August CPI coming out Sept 11. Yeah, probably. You know, my prediction was that the July CPI report would be a 45% weight. The August CPI report would be a 45% weight, and the labor market reports would be a 10% weight. Labor market reports we mostly think are going to be benign, and the July CPI report was benign. So if we get one more benign, I think then that just unprices it again, which would be good. But you know, that's kind of interesting. Let's see what else they say here. They've got, say, too low. Okay, ultimately September rate. He's not happy with the latest inflation. They do not tell me that underlying inflation trends have meaningfully improved. Any failure to back a rate raise would surely be met with a significant credibility crisis. Yeah, I agree with that. You know, if you're acting like you're going to put the pants on, but then you never actually put the pants on, then people are going to think you're a clown and be like, you're naked.
Indeed, we see about 8 times as many VIX calls being bought than puts this morning, thanks largely to one very big vol trader who bought just shy of $10 million of VIX calls 9 minutes after the open here at CBOE. They purchased over 104,000 October 21st, 28 strike calls in VIX for $9.6 million, the second biggest options trade on the entire tape this morning. For context, we haven't seen VIX that high since the early stages of the Iran war in March. The logic for a trade like that is pretty simple. If stocks get hit, VIX is likely to be very responsive from here. Add in the fact that VIX can also rise when stocks rip higher, and it's no surprise big money traders are buying calls here, guys.
Oliver, thanks. Oliver Rennick at CBOE. Coming up this morning, a lot more reaction to Jackson Hole with a lineup including David Bianco from DWS, Ashok Bhatia from Neuberger, Dan Niles, and former Chicago Fed President Evans as Squawk on the Street continues. Don't go anywhere.
Yeah, whatever. So, yeah, that's interesting. Just trying to reconcile options with this. Let me see if the CME has updated yet, the Fed rate odds. It's not as quick. This chart doesn't seem to update as quickly as you would like, but this indicates a 44% chance of staying. It's actually gone up to a 55% chance of a hike. So we're past 50-50 now. Great. So this means 9/11 CPI is now a potential catalyst? Yes, exactly. It does. One second here. Okay. So I'm trying to fix this silly feed over here, but it's okay. All right, what else do we have? So we know software has been bottoming out, which is great. Memory and storage getting stuck. We've got a storage rejection here, probably at 1500, but I've got my line at 1516. I've got Atlassian's doing really well. Nice bottoming over here on Atlassian. We don't actually have a retracement on Atlassian, but we can easily throw this in. We Don't have exposure to Atlassian, but we've done a lot of fundamental analysis on them, and they have very good numbers. Very good growth, great balance sheet, cash flow, very, very good numbers here. There's a lot to like at this company, so I'm happy to see this because to me it's part of the software rebound thesis, and it's really playing out here. Now breaking out over the 199 retracement, and look at this. We're literally, that's a perfect first fib retracement rejection. You could argue this right here is a rejection and a bounce, and now we're breaking through the next one. This is going to keep going for software. Hardware is a little bit more questionable depending on how NVIDIA moves here. You've got Palantir coming green today as well, even after some of the green that we've seen on software. UiPath is another one that's just really taking off of that low sub $10 level, now sitting at 18 bucks. Q's recovering, probably in this anticipation that, hey, the rate hike isn't imminent, but you really need NVIDIA to break through this test here. So we'll see how this goes. Yeah, how are the Q's up on this? Probably just this belief that, it doesn't matter now, right? Like, is he really going to do anything between now and, what's it called? And the election? Probably not is the thesis. All right, there we go. Okay, I think I reset that and that should function now. Okay, cool. All right, good. So let's see what else.
All the investor implications, both for the equity and fixed income markets, with David Bianco and Ashok Bhatia.
Plus, the impact on the tech sector. Could the AI borrowing binge keep rates elevated? We'll discuss with veteran tech investor Dan Niles. And did we get more clarity here or more confusion around the Fed's rate policy path? Former Chicago Fed President Charles Evans joins us.
Let's begin with some highlights from the Fed chair's speech in Jackson Hole and get back to Steve Leisman, who has had a little more time now to process what we heard last hour. Steve?
Yeah, I think Kevin Warsh in his debut or inaugural speech here in Jackson Hole, delivering an unquestionably hawkish speech, saying inflation's too high. There are a few signs the Fed is too restrictive looking at the economy, and he's not confident inflation moving back to the Fed's 2% target.
The responsibility for 65 months of sustained elevated inflation sits squarely with the central bank, and that's where it belongs. So here is my standard.
That was a hawkish line.
We must be confident that underlying inflation is moving to our objective clearly and at sufficient speed. Otherwise, we have work to do.
At the same time, Warsh was bullish on the economy, and he singled out AI CapEx investment and noted that consumers and businesses have proven to be remarkably resilient amid recent shocks. And for the first time, Warsh provided details on indicators that he's watching to gauge the economy, really reacting and meeting critics halfway who said he had not offered enough information on his thing. Here's a quick list of things that he's looking at. PCE inflation, 12-month and 6-month indicators. PDFP, a gauge of GDP growth. Credit spreads, which he said are not blowing out. Growth in earnings showing resiliency in the economy. And inflation breadth, that is the percent of indicators in the PCE that are above 3%. He didn't like those numbers. Well, look at how the markets reacted to probabilities here when it comes to Fed hiking rates. In September, up to 57% now from 35 before the speech, and getting more and more confident of a hike as the year goes by to 86% come December. Warsh stuck to his guns, though, when it came to his views about communication, the Fed not telegraphing where it's going, saying a quieter Fed, he thinks, is a better Fed. But he did show he's willing to offer more on his economic views than he had in the past, Carl.
Steve, long end, 516, 10-year down a bit. You think the long end is a believer here?
I think the long end is thinking about believing it. I think that's part of what has to happen here. Look, remember, he didn't guarantee it. He didn't say we're going to be hiking rates. He's still a little bit circumspect about those rate hikes. The market thinks he's closer to doing so. And you have to have a couple more months of inflation indicators here. There's going to be an adjustment to the methodology of one of the indicators the Fed watches. So the market, I'd say the long is a little more confident of rate hikes, but still a little circumspect, whereas the 2-year And the shorter duration, well, they're going to be much more affected, but obviously, if the Fed hikes rates here, so they're going to be much more sensitive. And that's obviously why you're getting that more reaction on the short end than the long end. I am a little surprised, given how hawkish I thought this speech was, that there wasn't more reaction on the long end. But
that's going to actually narrow the spreads quite a bit, which is interesting. Yeah, look at this. The 2-10 spread is down to 37. So that's really interesting. That's a bearish flattening. It's bearish because, well, let's see here. Yields up, bonds down. Because both the 2-year and the 10-year are going higher, and you're having a flattening. So it's bearish bonds, and then you're flattening on the spread or the distance between the 2 and the 10. Okay.
And the way that they think that Chairman Warsh is leaning. Look, I was trying to describe, you have to listen to Warsh on his own terms in the following sense. If you imagine a person who whispers and then says one word louder, well, that's the word you listen to. When it comes to chairman and Fed talk, Warsh is a whisperer. He doesn't want to talk very loudly, but he doesn't want to talk very much at all. So you have to take him on his own terms. And on those terms, in this regard, this is a hawkish speech that indicates or suggests the possibility of rate hikes, but of course doesn't guarantee it.
All right, Steve.
It sets up for December, okay? Let's stop beating around the bush. It basically guarantees us December hikes. Look at that 227 rejection again on NVIDIA. It can't freaking do it. It's a little baby. There's no money left to pump this puppy up. Come on, it's just a $5.4 trillion company. It can't be that hard. All right, so bear flattening. So, all right, shorts up more. So what does this mean? Short end up higher than the 10, the longer end of the curve. We've got, we've been flattening with the exception of obviously what we've seen with the drama around the war. That sucked. The 2-year reacts really fast to what it thinks the Fed is going to do in terms of hiking. You know, oftentimes people say the 2-year is just all you have to look at to see what ends up happening with rate hike decisions. This, it's almost like the 2 years repricing by going, oh yeah, he's going to hike. So that's not ideal. Serves to, ultimately tighten financial conditions because now you increase the borrowing costs for the AI trade, which a lot of the bonds are issued on the shorter term. We do get some long term. Google was issuing 100-year bonds in the UK, which hasn't been done since the dot-com bubble. But many of the bonds we see are like 2 to 5 year bonds, and the yields on those go up. So you just make the whole AI trade more expensive. A bear flattening, sometimes, especially when we go under zero, when we get the inversion, the direction kind of makes people price in a policy mistake, which could lead to a recession, which is crap. So let's write down some of those ideas, but I gotta hit the restroom really quickly, and then we're gonna write down some of those ideas.
Versus doom scenario. He's going to be bringing to the Fed a little bit of that optimistic version of what it can do for the economy and growth. And I think one of the reasons, we're seeing some of the positive moves in risk assets is a little bit of that thought process intermediate term. And I
thought
think
that was interesting.
Oh, sorry.
No, I was going to say, you're absolutely right. He did call it a new variable, but when it came to discussions about productivity advances, he kind of framed it more as a question than a statement. I've heard some chatter this morning that maybe some expected a little bit more in that argument.
No, Carl, I think that's exactly right. He talked about the risk of job gain, job displacement, job losses. I think he sort of checked all the boxes of the things that could go negative, and he certainly in the past acknowledged the productivity growth isn't we're not seeing it dramatically in the data now. But he's going to be chair beyond the September meeting, beyond the December meeting. And I think he's kind of revealed his bias here a little bit, that, he wants to approach similar to how Alan Greenspan did in the 1990s, that this can be a win for bonds. It can be a win for stocks and the economy ultimately over the coming years.
I mean, he had another big picture message, too, not only about the importance of AI, and they'll be keeping an eye on that for the future, but he very clearly said it's no longer a world of secular stagnation or a savings glut. I mean, he's signaling that we're in a different interest rate world regime from where we were, financial crisis to the pandemic. And I love the way he's talking about doing the research, being committed to the principles rather than a decision, and I love what I heard from him as an investor. Interrogate reality.
Interrogate reality.
I love that.
Yeah, that was a very popular line.
He's signaling that there are uncertainties ahead, but where we were the past 10, 15 years is.
All right. Enough of this. We need to jot down some notes and ideas about what's it called? This flattening. So let's do that. How are we gonna do that? Okay, yeah, here we go. So we're gonna set this up on the Meet Kevin app. It's all eventually just gonna be called the Reinvest app, which is fine. It's like the slow transition. It's like Meet Kevin becomes Meet Reinvest becomes Reinvest. All right. So here we go. Let's pop this puppy up. Okay. The recession concern due to bear flattening. All right. Bear flattening. A bear flattening occurs when the following: the long end of treasuries rise, but they rise less than the short end. Basically, both yields go up, bond values go down, and therefore the spread between the 2 and the 10 flattens. Okay? So if we get, and then that obviously has implications. So if I go to the 2-10 curve, see that right here. This is a flattening. Okay, the closer you get to 0, the flatter it is. And then you get to inversion. Okay, so let's plop that in. Actually, let's annotate a little note here. So this here, arrow, that collapse right here, the more rapidly this collapses, the more the bond market prices in near-term rate hikes, but the long-term moves more on the underlying state of expectations of the economy. So if near-term expectations skyrocket for hikes and economy isn't strong enough for that, this bear flattening signals hiking into a, you know, like, I should say it, strong now but weakening economy is the idea. Relatively weakening. Relatively weakening. Okay. So let's put this somewhere where it's not blocked. There we go. Okay. So that's what we've seen here. Now, how does that compare to, like, I don't know, 2008 or even the policy mistake of back in the day? Well, that would be interesting. Let's go pull that. So let's see. Let's go all Error fetching? You're giving me a fetching error?
Fetch me!
Come on, buddy. It's not that hard. Well, yeah, I can't zoom out all the way. That's fine. We'll go to a different source. 10-2, yield spread, St. Louis Fred. Okay, so we'll just go to a different source. Max. Okay, here we go. So this we saw at the end of the decade of the 90s, and we also saw it in 2004 and 5. See that rapid kind of flattening? And then, of course, recession still took time. It still took a couple years to get there. Let me see the date. What was it, May or March? Alan Greenspan's considered. Okay, we'll get that exact date. But let's zoom into those two eras. So we're going to zoom into, we can even include going into the 2000s, like going into COVID. So these are 3 eras of bear flattening. Let's grab those. It was May 16th, 2000. Okay. Okay. May 16th, 2000. So that was the deemed policy mistake for Alan Greenspan. So we had the flattening and inversion here. Flattening becomes inversion. Here we have flattening becomes inversion. And then here, flattening becomes flattening to inversion. So worst case now, Warsh actually hikes and then we do invert. That's your sort of early-ish warning signal, right? So bear flattening into inversion, then recession within 2 years. 2005, this was closer to like 2.5 years, within 2.5-ish, right? And then here also, I mean, in fairness, this was a little weird because it was COVID, but it was sort of like, you know, did we invert because COVID was starting, or were we already on that trajectory anyway? That one's a little weird. So people put an asterisk on this one. Did pandemic make this one weird / less reliable? Maybe. Okay. All right. So really then the what to watch for is, does a potential policy mistake cause an inversion again? So Alan Greenspan's policy mistake was supposedly around here. I say supposedly because it's a little hard to chart. So I'll just make that orange. And let's jot that onto here as well. Also go for orange. Okay. So this was May 16, 2000. Greenspan raises rates 50 bips to 6.5%. Final hike in cycle. Forced to cut aggressively starting in 2001. So, you know, people say that because of the bear flattening, the economy was already signaling slowing. So bear flattening was already happening when, what's his name? when Greenspan hiked here. And so people saw it as a mistake to hike into a weakening economy. And that doesn't mean the economy's not strong at that moment. It's just how many more sticks can it take, so to speak, or straws on the camel's back, right? Too many straws on the camel's back. This is hard to read. That's a little easier to read. Just don't really have a good place to put it. Okay. Come on, Kevin. Just put the text somewhere. You know what? That's it. We're putting a background on it. We're putting a giant box on the background. Can I do that? Yeah, there we go. Oh gosh, that's horrible, Kevin. Just bad at choosing colors. There. That'll work. Okay, cool. So we actually inverted before this. But he was on a hiking sort of tirade. Inverted before this final blow, so to speak. We were negative 51 bips of inversion by April of 00. Oops. There we go. Put that here. Okay. So bear flattening, inversion, recession is the essential sequence, if we will. So that means the signal now is we need to be watchful for that inversion coming again. The last time we inverted, we kind of got bailed out by AI. Let's fact check that. Hold on. Before I fact check that, because the RAM in my brain isn't that big, so I'm going to have to memory dump really quickly before I start putting more stuff in memory here. Otherwise, I'm going to die. The computer's going to restart. Okay, gotta clear the cache, man. Okay, so basically, the order of operations is bear flattening, inversion, warning signal, you're 2 years, you're within your 2-ish years from recession, and then recession. That's the order of operations. Okay. All right, that's fine. Let's put this under Fed policy. Okay. Now, let's go study the 10 and consider what happened after AI. So, that would be 5-year chart. Oh, I'm already on the 5-year chart. Okay, I'll just go to the 10-year chart then. So, we have this inversion here. Dude, oh my gosh. The inversion basically bottomed as AI went mainstream. That's crazy. The inversion chart literally suggests we got bailed out by AI. Because if a recession is 2 years later, but you got bailed out because of AI. Oh, that is crazy. That's actually really interesting. You know, so basically we just need like robots to come bail us out. That's crazy. And the labor market was, you know, weakening a lot, right? So here we had weakening labor market, weakening economy, signal, inversion signal. Signal suggested we're 2 years from a recession. But what happened? But AI boom bailed us out. Right at the bottom of inversion. That's remarkable. I mean, the AI boom, the GPT moment, was probably right here. Honestly, probably on that spike. I'm gonna go see the date of that GPT moment. What is it, like February, March? Yeah, dude, look at that. February, March. Literally February, March, double peak May. February, March to May. Whoa, that's cool. GPT moment, Feb, March 2023. Double peak May 23. Possibly NVIDIA earnings around that time, right? So, somewhere around there, okay? And then we get this sustained uninverting, in my opinion, as AI bails us out. This is the AI bailout. AI bailout. Instead of like a money printing bailout, you really have the AI bailout. Yeah. Yeah. That's logical. I think that's a logical interpretation. AI saved our butts the last cycle. Okay. So let's jot that down. And then let's take a quick look at also how the market is performing. So we'll throw that in there. That'll all be on the Meet Kevin app. That's crazy. I don't know why I think that's so cool. But, oh, I want to see what Nick T is saying. Yeah. Let's go take a look at a couple of these things. Okay. Nick T. Federal Reserve Chairman Kevin Warsh signaled the central bank may not be done fighting inflation, saying financial conditions don't look restrictive to him. And recent readings hadn't convinced him the trend was improving. Yes. Agreed. We love Nikki Leaks. We must be confident that underlying inflation moving to our objective, clearly in a sufficient speed. Otherwise, we have work to do. Stand committed to discipline. Does somebody? Chuck wants to know: does Marvell have any chance of recovering in the short term? It depends on Nvidia, and the answer here, based on this rejection, is no. Marvell is. You know, Marvell obviously had a Leofold margin up boom that was crazy. Even at 226, we're still well above where the stock has been historically. But looking at this in the super near term here, it looks like we just lost the 226 line, which that's funny because NVIDIA is 227. But, and also lost 246 here. We really need to recover some of these lines. And as you can see, we've just double rejected it. So double reject here. Hardware's having a hard time without NVIDIA breaking out. I mean, Intuit is doing better. Salesforce has another day in the sun. Oh, man, what a mess. So, you know, that NVIDIA reject sucks. Just, I suppose, put it that way. I'd really prefer to see a breakout on NVIDIA, and then you could say, hey, we've got a rally set up for hardware, like the 2.0 rally. But there seems to be this lack of capital. That sucks. Okay. Let's keep going with this journal piece. What saves us from the recession of robots if the AI recession is saved by robots? I think what you're asking me is predicated on the belief that robots are going to cause a recession? What saves us from the recession of robots If the AI recession is saved by robots. Oh, you mean, no, you're saying the kick down the road. That's what you're saying. I get it. Okay. So the AI, like, basically what you're arguing is, hey, we'll just get bailed out by robots. So what we really need to be worried about is what bails us out of robots. Yeah, right. You know, it's fair. Maybe robots will bail us out during the next inversion. Fair point. You know, if they can come soon enough. You know, my take is, I guess I could clarify my outlook on this. So my outlook is still bullish between now and end of year. I get more nervous going forward. We are seeing more risks that, you know, 27 to 2029 could see meaningfully higher recession risks if Warsh pulls a policy mistake, right? Hopefully he doesn't. But a policy mistake would align with, you know, if it happens, a policy mistake would align with probably peak memory prices and subsequent declines, peak suckening, peak spending, you know, think SpaceX, Google, Anthropic, OpenAI, peak suckening, Anthropic, Google, SpaceX, right? OpenAI is not on the suckening list yet, but they will be. Peak spending, peak capex, and peak shortage. Like, when all of those turn, growth rates are gonna suck. When all of those turn, growth rates start sucking. Not ideal. Hence, going back to this here, describe the economy is facing few signs of restraint from the Fed. Credit and loan markets are showing few signs of policy restraints. Yes, we know. Disagreement on whether inflation, blah, blah, blah. Softer inflation reads had eased pressure. Some reasons better than expected. They don't tell me that underlying trends have meaningfully improved. Right, we covered all this. Blah, 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 blah. All right. Nick T didn't actually really give us that much color there. Mohammed Alarian, this is a clear and powerful speech, in my opinion, meets the high expectations for Kevin Warsh's first. His remarks presented directly and effectively. Man, this guy wrote this with AI. Well, that was boring. So that's not actually very insightful. Okay. Nick T tweet. I will also say, if this occurs, right? If this occurs, okay, Fed cuts rates to 0. However, we have a whole note on the Fed task forces. Let me see. Task forces. Is task force one word or two? Task force. It's 2 words. Ah, great. Let me see. Where was my breakdown? Oh, here it is. See, here's my breakdown of all the people who were on the task force. Peter, Mervyn King, blah, 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 Karen, Doug, blah, blah, blah. All these people. Let's link to that post. My breakdown of Kevin Warsh's task force. There, that way you could look at it more easily. My breakdown of Kevin Warsh's task force suggests his task force is, on balance, heavily anti-balance sheet spending, money printing, and heavily pro-rate cuts. Okay, so that means rates get cut to zero, balance sheet, money printer stays off, a recession becomes a long U-shape. Money printers create V-shapes. No money printing creates a U-shape. Like, in other words, it's the longer bottom, right? Longer bottom. That's actually, because that's deflationary, gold and debt actually don't do as well. Gold and debt don't do as, I don't have to say actually, don't do as well. Hence why I think gold peaked when Warsh was chosen. I called that on Jan 30th. In fairness, it took 2 more days for gold to peak. So I wasn't perfect. There were still 2 more days. And he was chosen on Jan 30th. Okay. Then money printer stays off. Yeah. And then this I hate to say it, but aligns with, oh yeah, well, the market itself then has to drive yields meaningfully lower, which could happen as bonds become a safety play, to drive lending and growth than ever before. So basically, because the U stays down lower, basically, because we're in the U longer, bonds become even more attractive as an investment and asset class. The 60-40 portfolio is revived. The 60-40 stock bond approach starts getting cheered again. Everyone wants bonds and is underallocated bonds. And the effect of that, is rates actually end up lower than they ever were before, especially since you don't have inflationary money printing. Hence Kevin's crazy thesis from 2022 that in 2032 rates will be lower than ever before, actually happens. Which is really good for real estate. And value will then return to not the token layer in stocks and not the infrastructure layer, but the value layer. I don't know. I think that's a really good thesis. Damn. Yeah, gold topped like 2 days after Warsh was picked. And I said that right here. Okay. Okay. All right. So we got that. Wouldn't not printing when needed be the same as being too late in the case the Fed eventually does have to print? Yeah. Well, but that extends the U, right? That leaves you in the crap longer. The Fed's reluctance to print will be very bullish for bonds, because bonds lose value in printing, bonds gain value in deflation. That's kind of crazy, honestly. Then a depression is what, a W? Well, no, depressions are bad. But they would drive yields. Yeah, this could end up being deemed a depression if that occurred, right? Okay. All right. So where are we? Salesforce is doing great. The Qs are fine. Where is NVIDIA? NVIDIA still, look at that now, double bottoming potential here at 223. What happens to crypto in the thesis? Risk assets do poorly in this. Very, very poorly. Stocks and crypto do very poorly in this, going into it, right? Like, on the way down, everything really gets hurt, other than cash. So I should say, on the way down, everything gets hurt other than cash. Liquid assets get hurt the most. That's going to be, stocks, crypto. Bonds win. Real estate in undersupplied areas, IMO will work as shelter and will be the first to really boom up due to low rates. My take. So I actually don't see 2008 style real estate crash. Oh, here he is, Kevin Warsh wandering around to go take pictures outside. Some of the other homies, they got to do their picture day with all the other central bankers. That's cool. Okay. So, with all that said, I do want to take a look at Salesforce. I haven't done that yet. So, we've had a thesis, obviously, on the software cycle bottoming out. First time anyone has referred to real estate as shelter. Good one. Yeah. Yeah. All right. So, we won't belabor Salesforce, but I do want to look at Salesforce because I do think that, as we've been calling for a software bottom in Q3, Q4, it's happening. 10Q earnings report. So, pull that up here. Who's that hooded guy over there? You see that on all security over there? Hooded guy on the left. All the suits are walking by. Yeah, you got some more security in the back over there. We got the cops out in front and behind. It's the central bankers. Well, the central bankers. The creature of Jekyll Isle. Oh, man. Yeah. By the way, just a quick note, if you haven't yet, if you're a course member, if you haven't yet sent us an email, send us an email at staff@meetkevin.com to get your bundle code, because it's going away. The lifetime access it's going away forever. The ability to get lifetime access to the Reinvest, the Homes AI product is going away. Still beta, but it's getting good enough now to where, even as it's improving every day, we're going to a subscription model. And so if you're a course member and you want to bundle up, you could get a really special deal, lock in that lifetime access by emailing us at staff@meetkevin.com. Say you're a course member, what's your email? Hey, I want to bundle up, we'll take care of you. A lot of people emailing, so give us a moment, we'll get back to you. If you're not a course member yet, obviously you could also use coupon code JHOLE to become a course member and meet us. And people say this could be a tax write-off towards your investments and your trading or your education, whatever. Get every trade alert, all 9 courses, every private live stream, every alpha report, everything in the Meet Kevin membership. And once you have lifetime access, you keep lifetime access, of course. Okay. Let's now go look over here. So, How about BESS promising to buy back long treasuries? How does that affect the economy? I don't think it really does anything other than increase risk for bonds, so potentially increases volatility. It's actually, you know, on net more bad. But yeah. As far as, oh yeah, look at that. Q's just went red, and Nvidia going red. Even more so than it was before. Any chance you could open a tire purchases for course members? Probably not. The issue is, so I'll just be really transparent about that. These shirts are a pain in the butt to print. This is a really specific, like, ski attire that, you know, we really like. And they're expensive. Like, the base shirt is like $150, but they're really good quality. So they last long. I think they look good. But because it's a special material, we have to get special printing done on it, which is then, it's like, buy the product, ship it to the printer, printer's got to print it, then you got to get it back, then you'd have to distribute it to people who would want to buy it. It would honestly, like, to make it worth it, it would cost like $300 a shirt, and that's stupid. Like, there are no economics in that, right? I mean, unless I go print thousands of these, but I'm not going to because I'm just not going to sell shirts. So it's, I don't know, maybe one day we could figure out how to scale, but it's a pain in the butt. That's the bottom line. And it'd be way too expensive. So, you know, if you're ordering 10 of them, you know, what difference does it make, right? But then when you actually look at the economics of like, oh yeah, now we're gonna go put up a shop. What am I gonna sell it for? Even if I sell it for $200, people could be like, oh my gosh, $200, that's so expensive. It would be a loss. We'd lose money on it. We'd have to sell it for $300, and then maybe you'd make $50 on it. But who's gonna buy a $300 shirt? They can't do it, you know? So like, the blunt answer is the math says no. Anyway. All right. Salesforce. This is 11,345 divided by 10,236. 10.8% year over year total revenue growth. It's not actually that much, but the point is it was left for dead. People thought, I think, you know, people thought AI would drive CRM negative. So even 10.8% stable growth is better, right? So than expected. Expectations have been dead low. The margins on this product at Salesforce are just incredible. 10,820, so that is 2021 divided by 10,820. I've got 18.6% cost structure. Professional services is a little bit of sort of a money loser here, but I mean nominally. And so if I look at the underlying product cost here divided by 9690, 16.9% cost. So the margins actually fell a little bit. Margins did compress a bit. Okay, here to here. If I look at restructuring, you could really add this back in. And so if I add that back in, I'm looking at operating expenses of 6,365 minus 94. 6,271 divided by 5,662 equals literally 10.8%. So their OPEX matches rev growth. Their total cost of revenues, including their more expensive professional services, grew by 18%. 18% increase on costs. So that is some PP shrinkage. This is the margin. So I'm going to call it, I'm going to reword this to 81.4% gross margin here. And then the net margin at the company. See, like, the expectations were so bad, even though PP is shrinking, the stock still skyrocketed. Net income is 3,526. I'm gonna add in restructuring plus 94, but I'm gonna take out other income minus 81. It really doesn't make much of a difference. So I'm gonna go 3,539, restructuring in, other income out, 3,539 divided by top line rev. They have a net margin of 31%. Very good. That's very good. I mean, that's like a 2-6 peg justification, right? That, our current peg ratio on this, let's see here. Curious, where do you get the time to do the long-term live streams? Honestly, I hard cut off at 2, so I still have the vast majority of the day. That's at least my goal, and sometimes I'll cut out before that. And then, you know, it's kind of nice to have a little break, too, where you do like a market open and a market close. That's a nice functional way to do it as well. But there's plenty of time to do stuff. CRM. Okay, CRM. Okay, so forecast. $16.71, which is actually expected to decline next year. That's weird. $16.71 forecast EPS Jan 27. That puts us at a peg at 261 divided by 16.71 equals 15.6 peg ratio. Growth expectations are negative 4.69, 1574, 1685, 1414. That works out to, divided by 4, works out to about 10.5%. That means we are trading for a peg ratio, 1.48 peg. 2.6 is justifiable at these margins. Price target of about 456 is fair. You know, and then obviously, you know, if it gets to 456, it probably momentum's past that. Okay. Cash flow. So far, their buyback really paid for itself. This right here, yeah, see, they had no more money left to go do buybacks, so they didn't. Because they didn't have to. They already fueled the bottom, basically. Smart. Oh, what a bet. What a freaking bet. CapEx. So free cash flow of about $1 billion here. And this is lumpy, right? So free cash flow should be around 15 bill for the year. Lumpy, though, with renewals. And 15 billion, what's the market cap? So, oh man, NVIDIA keeps going down, and so are the Qs. Frickin' hawking. Warsh. Market cap is 213. 15 divided by 213. 7% cash flow yield. That's still really good. Still very good. And even at twice the price, it's still a 3.5 cash flow yield. Still better than Cyber or Palantir. Really shows how they've been, you know, Left 4 Dead. Anybody ever play the game Left 4 Dead? Love that. Unearned rev, accounts payable got 7 billion in bills. Okay. Enough cash to pay bills at 8.3 versus 7.5. Long debt is 39. 41 plus 4, about 45. 45 bill. About 25 bill of that was used to buy the dip at bottom around, 191. Close to. Accounts receivable, 9 billion over here. 9 bill in receivables and marketable securities. I don't think they're in a rush to pay off their debt. Let me see if I could find their debt. I mean, they just took on the debt. But I'll find it. Disaggregated revenue, agent force, headless. Okay, here we go. So this is the headless platform, which is in part what they're doing with Anthropic, like Claude partnership, where you don't have to log into Salesforce, you could access it through other programs. That part of the business is growing 20% growth on headless, whereas the growth on the agent force apps themselves is slowing on agent force. So you can see the growth from AI versus destruction from AI. That's actually very interesting. So that's growth from AI. And then if we go here, bookmark that, RPOs, blah, 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 debts, maturities. Those are their marketable securities. I don't care about that. Amortization expense, debt. Here are their notes. Oh, dude, they laddered this out. Oh, let's go. That's great. Look at this. I've got date of issuance. These are the last ones they issued. So their debt is all about 5%, 5 to 6%, their new debt. So that's a premium. That's a 20-year note right there. That's a premium of, what was the 20-year treasury in March? The 20-year treasury in March, we could calculate the spread that they paid and kind of see, like, what did the bond market say? So in March, we were about 5%, 4.9. I'll go with an average of about 4.9. Okay, so 4.9 for 20-year in March, about. That means the premium they paid for 20 years, 6.4 minus 4.9, paid about 1.5% premium spread over risk-free rate. I mean, that's not that bad. So that's their debt. Let's see if they gave any other notes on... The share repurchases should kind of be behind them. Did they give any notes on revs? Let's see. Management. Okay, increase in subscription and support driven by new business, which includes new customers, upgrades, and additional subscriptions from existing. Pricing was not a significant increase in revenue. That's good, because you want to hook people in, hook people in now, raise prices later, probably their thesis, right? Let's see here. Subscriptions, decrease in professional services. Decrease in professional services was primarily due to less demand for larger multi-year transformations. Interesting, which may continue in the near term. That's sort of a red flag. A red flag. So the red flag here, is if big transformations are slowing down, then you're monetizing the existing sponge, not necessarily growing the sponge. Thank you. So something to watch, right? Okay, and headless is only 34% of their business right now. You can see that right here. Headless, 34%. And I think a lot of that is happening right now. Okay, cool. All right, so we kind of got an idea here on Salesforce. We could take a peek at their earnings call in a moment. But let me mark this as the income statement and the projection we've done on their valuation. I'll pull up their earnings call. Let's do a check. It just look like Apple's actually green right now. Salesforce is green. The Qs are tanking. Hardware is not doing well. Intuit is doing well. But, yeah, I mean, look at this. I mean, we got hawked, man. We got hawked too. So it makes sense. Yeah, NVIDIA sync rate. I gotta add that soundboard back. All right, let's listen in here for a moment.
And so obviously that's a great margin push for them, but there is a question of how do you add to margin from the Siri AI side, because at this point they've only talked about cloud tiers as a way to benefit from services, but people really want to see Turnus put a strategy to monetize AI in their services sector, along with, as you pointed out, Eddie Q getting his strategy points there.
Yeah, well, the common theme is higher prices at Apple TV, and certainly Tim Cook has already spelled out why it's going to be necessary.
Subscriptions and annual recurring revenue are huge for Apple.
Get interesting. September is going to be busy for Apple. Mac, thanks so much. We've lost some of the gains. S&P's gone red as some of the yields have gone back to the highs of the session.
Right.
As I think the 10-year as well. We'll keep an eye on that. Next week's going to be crazy between G20 and then a slew of earnings of Broadcom and Dell and some others.
Well, you can see
boring.
Indices right now are sort of just running flat. We're kind of hovering around the flat line on the Dow, on the S&P, NASDAQ. The Russell 2000 is off by more than 0.5% at this point. So that's the news following Warsh's speech in there. But overall, I would say that the takeaway is that it was fairly hawkish and certainly keeping the focus on inflation and prices.
Yeah, we were thinking maybe we would go into the weekend with a 13 handle on the VIX, having gotten Jackson Hole out of the way. Still back above, still positive on the day, but 14 is not very volatile. We'll see what September brings. We know it's kind of fraught. Worst month of the year, average negative real return or total return going back to 2010. Thanks, CB. Always good to have you. Let's get to the Dominic Chu in for the judge.
All right, thanks very much, Contessa. Thank you very much, Carl. Welcome to the Halftime Report. I'm Dominic Chu in for Scott Wapner today. Front and center this hour, a reality check for the rally as investors react to commentary.
How much does a home inspector charge in California? Probably usually like $500. You check Enphase lines. Enphase, dude, it's a call option on data centers, and right now data centers are pooped. Oh, wow, yeah, okay, yeah, and Enphase is getting hit too. So Enphase, you really have to kind of look at like where the bottom was. $25. Yeah, all the way down at 25. Okay, let's keep listening over here.
We're going to check the markets right now. As Carl and Contessa pointed out, we are relatively calm right now. The Dow is higher by a modest 0.1%, or 71 points. The S&P is pretty much flat on the session right now. The tech-heavier NASDAQ trade off by 0.25%. And all of this in the wake of Fed Chairman Kevin Warsh's remarks at the Jackson Hole Symposium. You can see right now 2-year note yields ticking higher, 4.325%. The benchmark 10-year note yield currently just a hair below 4.71%. We did see a little bit of volatility around the initial remarks, only to see the stock markets dip and then recover mightily in the wake of that. You'll see that on the intraday charts, and we're kind of drifting a little bit lower right now. Let's go to the investment committee, and Jenny, I'll start with you. You listen to the remarks. There is a focus, perhaps, on the fact that inflation still remains sticky, and Fed Chairman Kevin Warsh did reiterate a commitment to price stability. Maybe that is the Fed independence narrative that many people in the markets wanted to hear.
I think that's true. And I also think, which is something I said that last week that ended up being a bit controversial, is I'm not sure it actually matters that much for the stock market. And the reason being is that we started the year at 4.2% on the 10-year, and here we are at 4.7 as we speak. And what's the market done? Just go up and up and up. And so I really think we need to think about, we have to, right? It's our job. We have to think about interest rates. We have to think what Warsh is going to do. But if we know that he's going to be quieter, if we know that there's a slight bias to raising and not cutting, And by the way, it's not an overwhelming bias. What is it, Kevin? Like 55% or what?
55%.
55% as of right now. So it's not overwhelming. Then
I feel like it's gotten worse, but we'll look.
You kind of say, hey, interest rates might be relatively steady. The Fed isn't going to have a heavy hand on that. And what does that mean for our portfolios? And what I think we do as investors is we continue the playbook of this year.
Jim,
just looking at earnings.
Does that sound right? Given the fundamental backdrop that we've gotten the bulk of earnings season behind us, there are still some bigger reports yet to come.
Polling, it is currently a 59% chance. So we've actually risen even more than they're suggesting here. It doesn't really surprise me.
So how does that set up going into September?
So I think what Jenny just said is absolutely accurate. By the way, I listened to the speech. I thought it was a very good speech. And, you know, there's some key lines always in these speeches. One of the key lines that he said is it's hard to say that Fed policy is restrictive when you look at the economy right now. So he's clearly telegraphing. Also, he said 100% the Fed's responsibility to get price stability.
Rusty in the chat says, McKay hooked me up. Looking forward to using it. Oh, that's awesome. Welcome aboard. That's really exciting. Yeah, the product's going to get better just every single month. You come back and look. I would expect to see improvement. I'm really, really excited about it. It's a really great product. So thank you for joining. Qs are now at 717. Shout out here, by the way. I'm just looking here. We've got Rudy, Reinvest AI. Welcome aboard. Catherine. These all minutes ago here. Catherine, Alpha membership. Welcome aboard. Hey, there you are. Rusty. Welcome aboard. Reinvest Homes. Ahmed, Reinvest Homes and the Alpha membership beta. So combination here. Jacob, Reinvest Homes. Dean, Jay gets a double bundle over here. Both Homes beta and the Alpha membership. Fernando, Herschel, Homes beta for both of you. Alpha membership for Singh, Dimitri, Homes beta. That's awesome. Well, welcome aboard, everybody. Taking advantage of the J-Hole coupon. All right, let's keep listening in over here.
Scenes there.
Are you calling 700 of the Qs? Well, this morning in our Alpha report, we did make a note. Let me see what I'll go look for you. Hold on. Let me go look at the Alpha report, what I said this morning. So, the Alpha report said, if we hear a long speech about how it's time to restore Fed credibility sooner rather than later, we go bearish down to 700 QQQ. Damn. It's not good. I mean, we're not there yet. We still have the 715 line, but that's funny. Yeah, that's what we had in the Alpha. We still have 715. So hopefully, we can still bounce off of that. How are we? So we got Atlassian's doing well. Let's look at some of the software names. We got Atlassian doing well. CRM's obviously doing well. We've got Intuit. I wonder how is Axon doing? Axon's actually red on the day. I've got Workday is coming back. We've got, how's Monday doing? Monday is green. ServiceNow and Palantir. Green for Palantir, green for ServiceNow. Let's go see what else we have. Path. And Path is actually 90 bips down. Team. What else? Meta and Netflix. Wow. Meta, Netflix, software and ad tier. Software and ads today. Amazon's up nicely though. And that doesn't really fit into that bucket. Walmart. AppLovin back to 322. Apple's up. AppLovin and Airbnb. AppLovin and Airbnb. Yeah. Then you've got, what else? Reddit historically has been, or I should say over the last couple weeks here, has been doing pretty well. Let me zoom out on that for a moment. So if we go, yeah, there we go. Mid-range actually on Reddit. Although their numbers, there was so much fear that they were going to get destroyed by artificial intelligence. All right, we'll throw APL and Amazon. Just sort of keep an eye on these. Amazon and Apple basically all-time highs. Whereas when you look at like, FANG, for example, Meta and Netflix have struggled. In fact, look at this. This is interesting. Look at this downtrend on Netflix. Let's extend this line. I don't want to screw this up. So without screwing this up, we're going to hold here, here, and here. Let's try to extend. Unlock. And hold in place to make sure I don't screw it up. Line. Let's hold this in place. This one is less useful, I could see. Unlock. Hold that in place at roughly there. Look at that channel we have for Netflix. And so we've, fallen below the channel a couple times, but we're now, hopefully creating an actual uptrend on Netflix. Because if you could now bounce, you're bouncing off the 200 moving average. That's incredible. 200-day moving average. Netflix, just above its 200-day as well. Okay, interesting. Let's go take a peek now. I'm going to put some bookmarks in the Salesforce earnings call. It's going to take me a second to get that up. Okay, hold on a sec. Let's listen in here and I'll get back to that.
Next quarter at $108 billion. I mean, that's incredible. So on one hand, you have the higher rates becoming a little bit of a stickier for longer problem, possibly a rate hike, but the earnings are very, very powerful. So I think that the market can support higher yields as long as the earnings come in, and that is a way better scenario to see markets at all-time highs because earnings are doing it, as opposed to us hoping and wishing for rate cuts and that not coming to fruition. So at this point, I think the Fed holds and we see a rate hike in December.
Yes. Some of the other things that Kevin Warsh did address.
I think he listened to my video. That was my conclusion.
Intelligence and some of the ramifications there. One of the key stories that's making its way through Wall Street traders and investors today is something out of the Wall Street Journal talking about the AI boom and just what it's done for the overall economy. That the headlines there, how the AI investment craze, that their words in the headline, is keeping the global economy afloat. Growth is holding up despite renewed tensions over trade, geopolitics, and bond markets, though the AI boom's outsized role is a growing concern. Jim, with what we now know from NVIDIA, with what we've seen from some of the cyber stocks over the course of the past couple of days that have come out, specifically citing AI as a massive tailwind, just how much of that word craze is accurate and how much of that word boom is accurate?
Well, I mean, it's subjective, of course, but why don't we use the numbers that Kevin Warsh himself used today? And he noted how high CapEx is from corporate America and attributed exactly half of it to the AI build-out. Now, that implies the other half is non-AI. And we do know from the budget bill passed last summer that there is manufacturing reshoring going on. So, this is an opinion, and my opinion is that this AI, I'm not going to call it craze, but this AI build-out is obviously additive to the economy, and it can continue without creating undue price pressures. Now, I say that last part noting that the PCE was 3.7%, well above the Fed's target, but well below where it was 4 years ago. We're not in some hyperinflationary environment where the use of the word craze would give us reason to think that the Fed's going to go on a massive rate hike campaign. It's a long way of saying there's a balance here between the good and the positive, but I think we're sticking it. We want this AI build-out to continue. We don't want it to continue at a level that causes the Fed to get super aggressive. I just don't see that happening right now.
Okay, so on the negative side of things, Jenny, we've got some commentary out of Bank of America's Michael Hartnett referencing the fact that positioning is in extreme bull territory right now.
Yep.
Summer consensus, no macro landing, no Fed hike, no AI capex cut, no Dem sweep, no fear. Intact, investors are positioned for A, rising earnings, B, capped bond yield, C, run it hot on Main Street and too big to fail on Wall Street, et cetera, et cetera. This is an interesting point of view given the fact that the markets sit right near record highs and have seen that kind of steady climb higher over the course of the last several months. Is that something we have to be concerned about?
I think so, but also even more importantly than us being concerned about it, like that anxiety and that sensation, I think that's what a lot of people out there are feeling. So I spent Monday, Tuesday, Wednesday of this week in Providence, Rhode Island, Boston, Massachusetts, and Portland, Maine, talking to clients. And they're feeling that, right? Like they can't express it the way Michael Hartnett does, but they're saying this seems unsustainable. It seems like a peak. Are we playing with fire?
Sure.
And what I said in response to that was, look, the market's up as much as it is because of earnings. And between now and the balance of the year, I think those earnings are kind of locked in. So I think we're in an air pocket between now and October, and then we'll hear October earnings, and they're probably going to be like NVIDIA's. They're going to be excellent, and they'll be what we expected. But as we think forward, I think the lens needs to shift a little bit to the reliability of earnings projections.
Yeah, right. Because of expectations being too high. Let's go look at the Salesforce earnings call summary. We're here at the Salesforce Tower, San Francisco. I want to welcome you all. Blah blah blah. Salesforce. That's why I'm so excited about Claudeforce. Best of both worlds. We're combining Claude's extraordinary intelligence and reasoning with Salesforce's trusted data. And while Claude might have been, for example, for developers, it's now that for knowledge workers. And when you do that, you get something the world has never seen, deeply personalized interface that reasons. It's truly a game-changing experience for our customers. Yeah, for now. It's a sponge issue, right? Like, are you squeezing out that sponge too hard? Okay, Dreamforce. Customer started the agentic journey with Salesforce. Let's see here. The only thing I need to do is convince every single customer why Mark is on the road from time to time. What? Blah, blah, blah. Agentic journey. Blah, blah, blah. Okay. Boring. Let's see here. Let's go to the next one. Slackbot. Slackbot. This is probably why they came up with Grokbot, honestly. Which is also kind of cool. Everybody's going to end up having a bot. Okay. Let's get this set correctly. Okay. So this is Slack continues to sign. Q2 Slack was the fastest quarterly growth since acquisition. Really? That actually surprises me. AI innovation across the platform is delivering measurable value. Agentforce hit 1.5 billion. Slackbot and headless launches continue the AI momentum. Upgrades to our premium Slack editions have tripled since we launched Slackbot. Wow. Selling Slackbot AI, triple premium upgrades, and then we have fastest growth since acquisition. It's actually incredible. Yeah, we need to meet Kevin Bot, exactly. So, can we get a Fed Day boom if he comes out dovish after being hawkish today? Depends on what the next CPI report is. Yeah, we kind of shifted the catalyst a little bit, huh? So, okay. Well, that's good. Solid AI growth. You know, that's more than the sponge, so that's optimistic. People finance are builders. People are builders. Be able to use natural language. Blotty, blotty, blotty. Whatever. Yeah. So philosophy is we no shortage of replete apps that we're building on top of Salesforce. Yeah, there generally never a shortage. There generally is never a shortage of apps. There's just shortage of good apps, and good value. Like, I think there's a lot of value in the fact that, you know, when you get the Meet Kevin app, you could get the Alpha Wire and a bunch of the other features that we have in there. There's some really cool stuff in there. No shortage of replete apps. Okay. Blah, blah, blah. No shortage of, blah, okay, utilization, yeah. All right, that's fine. It's replete and headless. fine. Surface area is changing. Everyone has logged into Salesforce, but if you think about Ligorians logging into Salesforce and the traditional interface, the answer is it's changing every single day, split by role. The surface area is expanded. Logging into Slack, they're engaging via Slack, so we're expanding. Updates going to Salesforce. Our pipeline, our AI is handling busy work. That's AI jobs, but the human layer, adding judgment, that's sales on top. Right. Yeah. Like, basically, easy interface, interface for humans to get the data they need. You know, lookup function is BS anyway, and tedious. And then humans make decisions. Yeah, the limiting factor for AI is, you know, how many decisions do humans really have to make, right? Like, you know, I don't need to ask AI what shoes I need to wear today. There are only so many business decisions or document decisions I actually need help with at any given period of time. And that's true for most businesses. I'll write that down. Limiting factor. All right. I already have to go to the bathroom again. Job is not to do legal areas, work gets done. Scale to an organization, 50 markets, finance, security, compliance. AI created, the CFO. Fine. Scale at organization. AI helps roles scale. That's fine. Legora is the fastest software company with a sales force to go from 1 million to 100 million ARR. We did it in less than 18 months. Cannot afford to change our CRM again. Okay, I want to know a little bit more about this. This is Legora. For legal professionals. Okay. So this is legal works without limits. Collaborative AI for exceptional lawyers. Oh, okay. Solutions. Litigation. Let's see. Streamline your litigation process. And this just looks like ChatGPT. It literally does. Provide a case summary, identify and analyze core legal issues. I mean, this is literally like a GPT. But they have the integration of all the documents. Okay. So do they just have like an app on, let's see, Salesforce Legora app, let's just say. Legora, and the connection between stems from a massive $500 million Series D fundraise, which was backed by Salesforce Ventures. Okay. Salesforce Ventures. Is that it? But what does that have to do with... Oh, I see. Legora describes Salesforce as their sort of system of record. Okay. If that's true? I mean, is that what they have here? Let me see. Legora. With Salesforce. Yeah, fastest software company with Salesforce. That's what they're saying. So they're saying they use Salesforce. Legora sees AI as a capacity expander. I agree with that. We can now take on more. They can now take on more work. Yeah, I agree. Ligorians logging into Salesforce in the traditional sense, basically, no. Right. So, idea is people use Salesforce through chat app rather than traditional CRM apps, which is actually, that's where we're seeing the growth too. Okay. They're unlocking value where they've never had it before. So much for the SaaS apocalypse. That concludes our pre-show. Okay. Legora, now Zero going deep with Agentforce. Legora employees work with Claude and GPT every single day. They built with Cloud Code. Now, these are different reasoning engines, entirely different interfaces, but underneath 3 different trusted foundations. Salesforce. Okay, interesting. So basically, you know, in the earnings call, Salesforce suggests they're the foundation for Zero, Legora, and a replace. Why do they keep Salesforce though? I guess that it's probably like the headache of moving the data and all the CRM, but I feel like AI. But why do I feel like AI could just move all the data to their own CRM? I don't know. You know, I would almost call that just still a little bit of a red flag. So I'll call that my Kevin's red flag. Q's fighting. Does that mean what? Trying to stabilize? Q. Oh, wow. We went all the way down to 6.7. Oh, my gosh. Yeah, no, that's not stabilizing. Yeah, and NVIDIA is tanking too. Let's put these at the top. Q. Hardware is just getting creamed. Okay, so... Zero's an accounting service. I see. Okay. With 5 million subscribers. Agentforce enables real-time customer support at scale. Ah. Okay. That helps. So, Zero, accountants, finance platform, 5 million subscribers. Agentforce handles customer support at scale. Okay, then you've got Legora, uses Salesforce for audit trails and governance, apparently. So compliance, it sounds like. Compliance. And then Replete is using it for sales. Okay. So... I still don't know, you know, why not just rebuild with, you know, Claude Code? That underlying compliance or, you know, CRM. I mean, so far, that's not happening. That was the fear. That was the OG fear. That was the original fear that led the company stock to tank. So, you know, while now it's re-rating up, software bottoming, it doesn't eliminate the fear. I think that fear is still kind of there, that could happen. Okay. What else? So that's, I'll call that my red flag. First 7 months, clear as tell, central file tickets, marketing, operation, blah, blah, blah. A lot of these companies, honestly, are probably focused so much on grinding revenue right now, they don't have to optimize yet. Legora, for example, can probably optimize for revenue right now instead of perfecting their costs for now. That's probably a bit of what's going on. Okay. Then critical word, Salesforce system of record, blah, blah, blah. Okay, we've heard that said many times now. Capabilities, accounting, payroll, agent force. Many questions answered instantaneously, 62% deflection. I mean, yeah, we know chatbots are useful. And then SaaSpocalypse. Okay. I mean, yeah, that gives us color on Salesforce here, so we kind of understand what's going on. It's just too early to actually care about that disruption when you can probably monetize a lot more with artificial intelligence and focus on, you know, optimizing for growth right now and worry about the costs later. That's probably it, which, you know, gives software a good rally opportunity, but those issues will remain, and at some point, you know, continue to be a concern. Even for a company like Palantir, in the long term, that'll end up being a question. It's like, oh, well, companies just sort of make their own. Okay, let's go listen in over here.
Report that the stock went down because it was just too expensive. We've seen that with other stocks like TJX. So I look at this Best Buy. First off, the consumer is in great shape. I know the consumer feels lousy.
I don't know about that, man. I don't really want to bet that heavily on a consumer right now. Consumer might seem like they're blowing everything, but they're saving nothing, man. Savings rate has gone to crap. This guy's smoking crack is what's going on.
Sure, it's down in the short run, but over this past year, it's had a great run. This is just consolidation.
All right, interesting setup for sure there. Now let's turn to Brandon Gomez, who's got our CNBC News update this afternoon. Good afternoon, Brandon.
Hey there, Dom. Congo's Ebola outbreak has spread to 2 more health zones, bringing the total affected to 60. Government figures show over 5,700 confirmed cases and close to 2,800 deaths. The World Health Organization says the outbreak remains out of control. Doctors Without Borders has opened a new treatment center while Congo is vaccinating frontline workers. The current strain has no approved vaccine or treatment. Walmart has settled a Justice Department lawsuit accusing the retailer of helping fuel the U.S. opioid epidemic by unlawfully dispensing controlled substances at its pharmacies. The department said Walmart failed to meet its obligations under the Controlled Substances Act. Financial and other settlement terms were not immediately released. The federal case was filed back in 2020. And Miss Virginia, Justice Kelly, has been crowned Miss USA, becoming the first mother and first married woman to win the pageant. Kelly beat 50 other contestants Thursday night in Miami. The milestone follows a 2023 rule change allowing married women and mothers to compete for the title. So a big congratulations to her, Dom.
Congratulations for sure. Brendan, thank you very much for that. Coming up next on the show, Mike Santoli joins us with his midday word. Keep it right here. Halftime is back after this break.
Always go to break. I'll be right back. It's assuming they're not on ad here. Oh, of course they are. Okay, fine. Fine. I wanted to get a snack too really quick. It just always happens to be right when they go on ad. Losers. Man, don't they know I want a snack? How rude. It's okay. So, yeah, look at that. 715 bounce on the Qs right there. That's pretty remarkable. Oh, I think they're back.
The 10-year yield also making some moves, not doing a whole lot. Here's the 2-year yield chart, and that just gives you a sense of where things are right now. Warsh making clear that the recent inflation data, CPI and PPI, not entirely encouraging. If you look at what's happening in stocks, we're at session lows right now for the S&P 500. Still, you look at the major indexes, the Dow, the S&P, and NASDAQ, they are all set to close out the week with gains. Then VIX slightly higher, but really very quiescent.
It's
down.
like Christmas music. It ain't Christmas. Unless they think the red in the market is like half Christmas or something. I don't know. We need some more green to make this Christmas. Jeez. All right, let's go look at yield. Yield. All right, let's see how we're doing here. NVIDIA red flags. Hey, I made a video about NVIDIA red flags. Did they copy my video? Dang, bro, look at the 10-year. 4.72 now. What snack am I having? I'm having a Good and Gather organic fruit and grain bar. Strawberry. I honestly shouldn't have this crap, but it's kind of like a little cheat snack. The babies like them too. Okay, come on. Load the rest of the bonds. I want to see the 2-year. So the 10-year just went crazy. Oh, here we go. 2-year. Wow. 2 years at 4.33. Dude, in my Warsh video, like 10 days ago, I said, unless we get the 10-year, or sorry, the 2-year to 4.35, there's a chance we're going to get hawked. And then we got hawked, and then it skyrockets up to 4.35. All crazy. The second quarter earnings report contains a few numbers that should give investors pause. Okay, let's see about it. NVIDIA reported a 63% rise in accounts receivable. Well, I think if I remember correctly, in their earnings call, they actually mentioned that they're like intentionally extending those time frames. Yeah, wait for OpenAI to get his money. NVIDIA earnings call. I'll pop it up. I can't remember if it's the earnings call or the CFO commentary. You think you'll ever day trade again? We had a blast with day trading, a lot of it. I have a problem because of the position that I'm in. When I was day trading a lot, they hit us up and they're like, you need to register as a large trader. And I'm like, uh-oh. You have this like microscope on you where then there's too much of a risk of a potential of, okay, great. You know, is this like the SEC trying to microscope and go, okay, that's it. You know, you traded this and now we're going to allege this. And I'm like, there's too much risk as I feel like somebody on YouTube to trade on like an intraday basis, just because of, you know, if you go into 2029, you get like a Dem sweep or whatever, and the SEC goes kooky, well, or goes intense on regulation. I think there's some real risk factors there. So for me, I really like long-term. I like trade. You know, I've got a lot of, you know, the trade ideas that we share for the very short term. But for me, I prefer long-term for what we're doing with our capital because it plays very well into our long-term thesis. And it's much less risky combining social media and the news and the content that's created. So anyway, let me go. What I'm going to do is I'm just going to ask the PDF. Any commentary about extending receivable time frames? Let me see if I could just get, because it'll give me a little indication. Yes. Okay. I knew it was here. Days outstanding. That's the section where it was. Oh, it's right here. Okay. See. Oh, look at that. I already highlighted it. Days of outstanding sales increased to 60 days, reflecting extended payment terms for large purchases by certain investment-grade customers. Excuse me, to be shipped over multiple quarters. There it is. You know, again, the CSPs and Frontier Labs need to raise money to spend. Okay. Cool. What is the other red flag junk they have here? This is NVIDIA. Here we go. So we got the receivables. Rise in accounts receivable. Hefty increase in the number of orders the company has filled but haven't been paid for yet. The numbers are so big. They're making really big commitments way out into the future. Right. I agree. Bank of America sees accounts receivable going to 71 billion, to 113 billion, to 147 billion. That would be a 100% increase over 2 years. Yeah. Yeah, basically, you know, we're recognizing this revenue, but we're just putting it into the receivable. We're not actually getting the cash yet. That's actually interesting. Just how much is expected to balloon. 5 customers accounted for 70% of its accounts receivable. That's obviously a default risk, right? 3/4 accounted for 56%, or 3 customers. Some teaching videos on fundamentals and basics of day trading. Yeah, we could probably do that. More than, what's in like the courses. We could probably do some public videos on that kind of stuff too. Income backlog is growing. Videos back showing. Commitments. This is the circular financing. Commitments doubled from 119 to 179 in the second quarter. What else? Analysts at Goldman Sachs say these commitments are substantial. $279 commitment for memory, data leases, equity investments, CapEx, drop in free cash flow. Well, then the free cash flow is partly because of the accounts receivable, but then you also back out the investments that they're making into other companies, which, if you have to keep making investments into other companies, then that's sort of like reducing your free cash flow. All right. That's interesting. Okay. That's all. I think those are all reasonable things. We've kind of hit on a lot of this. Oh, we got a little bounce here at 7:15. Which is good, given that, there's been a little bit of a sell-off. All right. What is this? Demo of app. Oh, yeah. Okay. Sure. So, we've added in this little tab here that maybe a lot of people aren't fully aware of. So I'm just going to show this really quickly in the Meet Kevin app. In the Meet Kevin app, when you download it, you get this sort of data tab. The data tab right here, great way to kind of see data and images that we're writing up, which you could then download or whatever, which is kind of useful in the Meet Kevin app. You can get the historical kind of videos that we've made, the daily wealth I send out every day. If you don't want that, you could disable notifications for that. Commentary on stocks, those are going to be, that tab's for course members. Then you've got the investors tab on, why does that say unavailable? Oh, I have to fix that. But anyway, because that's the last update. The update video should work. I think the embed is just broken. Oh, yeah, the embed's just broken. Okay, I'll fix that. But anyway, we did a little, there's a little update tab for investors. That's just up there. Then at the bottom, you get the alpha report, along with some other tabs that you could take a peek at for like the course member live streams and otherwise. Then at the very tippy top, you go to the terminal tab. You could switch on over to terminal, and then that's where you could get the wire feed, which is useful. So you could look at the wire feed for today or yesterday or the day before. You could also sort by categories if you really want to. The stock AI tab, where some sectors aren't ready yet because it's still in beta, cyber and pharma specifically, but I think this works pretty well. You can go type in Salesforce, for example, and then you can kind of get a fair value note on this. You can see some of my notes on it, balance sheet, pricing power, moving average, whatever. And we're updating some of the layouts for this to make it even simpler and better. So we're always trying to improve it. The Homes AI tab is down here. You could put in you can save or reject listings if you think they're a good deal or not compared to what the app does. And then we got the little suits tab for congressional trading, some sell signals, whatever. And you can sort by politician too. So, if I go in here and go, let's go look up Nancy Pelosi. So I could see her Bloom Energy purchase, Intel purchase, whatever, which is kind of cool. So it gives you a little overview. And then, of course, there's some other tabs as well over here. Earnings calendar. If we go up to, let's say, Tuesday, Medtronic, Neo, Monday, Wednesday, Broadcom. So you got Broadcom, Snowflake after the close, Hewlett-Packard. That's kind of nice and useful. Macy's is on Tuesday. Thursday, we've got DocuSign, whatever. That gives you a nice little overview, I think, of tools. And there's more coming. But it's kind of cool. You know, we didn't have all that stuff, like, until recently. So a lot of that stuff is pretty new for folks. So it's understandable that people wouldn't be super familiar with all of it. But you can download the app for free, which is kind of cool. There is no CPI month-over-month consensus yet, Mr. Lagging Indicators, yet. At least as of this morning. I checked this morning and there was nothing. So I'll look again right now because I actually have it up. Yeah, I don't have. There's not a single surveyed estimate yet. So you probably have to wait until next week to get data on the CPI consensus numbers. Nothing right now. All right. Keep going. What else do we have? The Info, the FT, the Economist, the Journal, the New York Times. Okay. Let's see here. Notion plans hiring binge as CEO makes all-in bet on AI. As AI has reordered Silicon Valley, has unleashed an adapt or die reckoning for a few members of tech's older generations. Yeah, I agree with that. That's true for 13-year-old Notion. Popularity shot up as a note-taking app, found itself in an awkward middle ground. Remains a tech darling. By other measures, Notion looks less rosy. Mobile app usage is stalling, according to Sensor Tower. Notion faces questions about whether alternative products could eat its lunch. Right, so they really have to be a data repository. It has introduced AI to transcribe meetings, automate databases, and allow people to search their Slack messages and Google Drives without leaving Notion. Inside Notion, they've created thousands of agents. Sales lead, product feedback, whatever. Employees hunger for simplicity of an outright sale to a bigger company. Well, whatever. That's a big deal. Okay. I don't know. I don't really care. I'm not going to read all this. But yeah. It is a big question. Like, hey, is Notion really necessary in the age of AI? I always found Notion was way too complicated. Maybe AI can actually make it less complicated, which would be a win for them. If AI could make Notion more functional without, what's it called? Complexity. Maybe there's a function of that. It's just, do people still want to put data in? You know, is it easier to go into Salesforce Slack and just be like, hey, update this into the database? You know, that'd be the nice way to do it. All right. Let's see what else we got. So that's the Notion piece. The Info. QQQ retest. 715. Dragging along the bottom. Kevin, I remember you saying Warsh was the worst pick out of the three when we found out Waller, Reader, Rosh. Yeah, that's right. Has he pretty much been what you thought he was going to be? A pompous prick? Well, I think he has no credibility because of his behavior from 2008. And I think he's going to make for, you know, when the next recession comes, he's going to be your worst friend. You're going to hate his guts. And so far, while he's trying to build credibility, I don't think he actually will. We'll see what happens. He's got a lot of damage control to do. We shall see. Tencent flagship AI app or AI model shows progress. Let's see if they give any benchmarks. Visa says its AI harness makes Anthropic's cheaper to use for cyber defense. Okay, what is this? Anthropic's AI is pricey, but customers are finding ways they can use it more efficiently by adding software known as a harness to control the way they operate. Visa in April developed a harness that reduces the cost and time it takes for Mythos AI to find cybersecurity vulnerabilities in its code base. Okay. Company has declined to share specifics, pointed to a July study that showed a similar harness could cut the cost of AI models by as much as 60%. The harness effect. Oh, this is a big old piece. Let's just look at the abstract. Let me download it really quick. AI harness study. Okay. AI harness. Okay. Too tied to Trump, indistinguishable from government, huge drag on credibility. Oh, 100%. I use Oh My Pie with Herder and Terminal or DeepSeek harness. Oh. Undad. Undefeated. Undefeated. I get it. That's cool. Dominant pattern in agentic AI development is what we call token maxing. This was from July. Buying capability with tokens, longer reasoning traces, more agentic terms, wider payloads, larger replayed context. So tokens grow faster than task value. That's bad. Falling token prices mask the pattern without fixing it, and then total spending rise. We argue that a decisive lever against token maxing is the harness. The orchestration layer that assembles the context, exposes tools, sequences turns, and delegates work. Okay. To isolate this layer, we run a controlled swap. Locked some foundation models, changing only the orchestration layer. Conventional production loop, frozen baseline, writer agent harness, holding models constant, placing the harness at the core of execution. Okay, here's the point. Placing the harness at the core of execution cuts blended cost per task 41%. Okay. Okay, let's write. That's interesting. 41%. Median wall clock by 41%. I don't know what a wall clock is. Median wall clock. We'll look that up. And tokens per task by 38%. While headline task completion quality holds at parity. Efficiency gains are model invariant. Every model gets cheaper by 33% to 61%, while the quality gains are capability dependent. The improvement a model extracts from the harness correlates almost perfectly with its baseline strength. Quality per dollar raises 82%, and task completions per millions rise. On this workload, the orchestration layer moved cost per task more than switching between the cheapest and most expensive model did. We formalized token economics at the orchestration layer, including effective input price models, under prompt caching, defined token maxing, 60, yeah, blah, blah, blah. Okay. Okay. That's extremely dense. But basically, okay, orchestration layer more important to output quality than going from cheap to frontier model, or expensive. Okay, that's actually, bearish again, frontier. Okay. Orchestration layer. Let's see here. So this is placing the harness to the core. So blended cost down 41%. That was a takeaway. Wall clock, oh, it's 48 seconds to 20 seconds. I'm going to assume that's time. So time down, 48 to 27 seconds. So 44%. Okay, that's just the time of actually, like, running it. Token usage down 38%. And quality holds stable. All right. So this is really a kind of a way, what the harness does. Harness actions. It's kind of like, hey, let's clean up the context. Let's use the right models for the right components of the prompt. Think cheapest when cheapest will do sort of thing. And maintaining context. That's kind of, and you can also link to APIs as well, stored workflows, and presumably even like a Salesforce database, etc. So the orchestration layer is what they're referring to here. Okay, I like that. This is really interesting. So if we now compare this, now we have a little bit more intel here, and we go back to the article. This is what Visa is talking about. Using the models through the harness is more effective than using the model itself. Okay, I agree with that. The harness is software that hands the model tools, such as to GitHub or Slack. Yeah, that's like what we saw with Salesforce. Feeds context about the user and their preferences. Oh, there, yeah, okay, there we go. That's another way to put it. Instead of an employee telling Mythos what to do, the harness software breaks up the process into stages, fixing the process, and handles some of the work up front, such as mapping out what should be scanned. Yeah? Undefeated says, creates to-do lists and guides the models. I like that reference. Rather than overwhelming it. I think that's a good reference. To-do list versus overwhelm. I think that's a good way to put it. Took nearly 100 employees 3 months to make a harness. Yeah, it probably saved them a lot of money, though. So, I mean, really, you could almost argue that the Agent Force product is kind of like a harness. Can you? I mean, because it pulls in the data from the other sources. Maybe. All right, whatever. Let's write down other companies that are like that. So there's Salesforce, Slack, or Agentforce/Slack almost becomes that orchestration layer to some extent. So, that's like a CRM now, Copilot, you could say. Copilot by MSFT. Workday has an agents product on this. It's called Illuminate. Agents. CRM has Agentforce. And now, there we go, has Control Tower / Assist. Okay. So, I guess you could probably put Palantir on this list too. Palantir, Sovereign AI stack. That was heuristics to ontology to Sovereign AI. There we go. Okay. Yeah, because Palantir basically hot swaps models. Regularly talks about hot swapping models. So, okay, let's go back then to that piece about the harnesses, which is right here. So Visa's open source software, Visa Vulnerability Agentic harness, so other companies can use it. And on Thursday, the company updated the software so users could easily switch between Anthropic, OpenAI, and OpenWay models. The harness noticeably reduces the time between when the Mythos model finds a vulnerability and actually fixes it. Time to adapt. Yeah. What else? What else? What else? Blended Fire, Visa became Anthropic's Glasswing. Yeah, that's interesting. On the harness layer. Okay, let's add that to our Meet Kevin app. And we'll link this info piece. Let's grab this. This is my commentary, and this is the abstract on the PDF. This is the header. And we can actually link that study too. Okay. I'll slap that all in there. Slap it! So this is the AI harness by Visa. Study link was here. Visa by the information. Visa via information. Throw that here. Basically, harnesses make you use fewer tokens, maintain context and workflows, minimize spend, and maximize quality. And that sounds great. Everything you want. Another bear claim, though, for the Frontier Labs. Okay. Okay. What else? Tencent's new flagship model. Chinese tech giant Tencent Holdings launched a preview version of its new flagship open source model, High 4. Significant improvements. Benchmarks suggest they're emerging as a competitor to Baba and these others. On the code arena, they're ranked 5th. Let's go see. It's an X post. Oh, there it is. Opus 5. So right around Claude Opus High. And Claude... Wow, there's... Wait, why is Claude Fable so low? Oh, code arena. I wonder if this is... Oh, this is on web dev. I'm surprised. I thought Fable was going to be better than Opus. Apparently not for this purpose. Humans' preference. Live votes, blah, blah, blah. Huh. Okay. More competition. But that's pretty boring. That doesn't really tell us anything. This competition for low-cost models. We know that 50 cents. Whoa! GLM 3.5 only costs 15 cents for an... Okay, yeah. I thought it was going to say 15 cents for an output. I was going to say, because Quen's down at like 41. I thought that was low. But they're at 50 cents per output. Okay, yeah. That's already old news. So we already know that. Then Wall Street learns to love software again, bro. It's a software bottom. It's a software bottom. Oops. OpenAI leads new call cyber defense of critical infrastructure. AI regulation stalls. What? Republicans stalling regulation? No. How are the Qs? Oh, come on. Going back for the test. Nvidia's now down 4%. Anthropic has been working on a plan to let existing shareholders sell some stock on its IPO. Oh, come on. While also considering a longer IPO than usual. Bro, dude, these people are cashing out. Not even Elon did that. Elon didn't even do that. Elon had the balls to stay with the ship and take like the longest lockups. I mean, the guy's got plenty of money. It doesn't freaking matter. You don't have to sell a stock. But still, I mean, they locked up their employees. Sell some stock in its IPO. Allowing secondary stock shares on an IPO would distinguish Anthropic from other big tech listings like SpaceX and Cerebras, which didn't have existing shareholders selling the IPO. Some other big IPOs, including CoreWeave and Figma, did. Stock sales would enable Anthropic shareholders to access a portion of the enormous wealth they've amassed on paper. That actually reduces the amount of the sucking available for NVIDIA. Yeah, Huawei's got pretty decent chips. I was just doing a piece on that too. That's my iPad over there. I don't really want to deal with that right now. But yeah, the thing with these other chips is they're not NVIDIA levels, but they're, you know, pretty good. One sec. Quick set locks are for the bottom for each garage door. And then the top gets the new software lock. Cool. All right, cool. Whew. Oh man, there's so much going on today. Kind of like it. Yesterday, I was on yesterday for the earnings calls or the earnings reports. I was running on like 2 hours of sleep because that night we were at the hospital and it's like, oh, this is a mess. I'm getting no sleep. How am I gonna function? And now I feel rested. It's nice. Okay, stock sales would enable. Okay, yeah. How to manage sales by investors and employees are among the complex issues Anthropic is wrestling. Bankers have discussed an IPO valuation of 1.5 trillion to 1.7 to just below 1.5 that SpaceX fetched. New York Times reported it could be as high as $2 trillion. Anthropic, which has raised $130 billion but needs more to fund its vast compute plans, is expected to top the $86 billion that SpaceX raised. That's so crazy, man. It's so much sucking egg. The company is planning to publicly unveil the IPO perspective after Labor Day. Why? Wait. Labor Day 2026. September 7th. Oh, I'm going to update that catalyst then in our alpha. Okay. Shortly after Sept 7, Labor Day. Expectation. I will update that. That's interesting. Okay. IPO would be held in late September, October. We've been hearing that. Though Anthropic could push that back. Okay. One is reduce the need for an early lockup release. The move could allow employees to raise cash. But then they might end up doing a longer lockup for the rest. 180 days. Imposing a longer lockup than 180 days. Not clear how long. Huh. Alright. Wall Street learns to love software again. Oh, man. Forget the SaaS-pocalypse. It's a SaaS renaissance. Yep. Shares of Salesforce rocketed 23% on Thursday, leading to a recovery for many beaten down software names, including these others. After Salesforce beat, the rally signaled a striking change in sentiment for the sector, which has been slammed. Change in sentiment. Thursday's rally extended cybersecurity-related stocks that hadn't been swept up in the SaaS apocalypse, right? CrowdStrikes. Of course, it's likely that investor sentiment will change again. I actually agree with that. The Salesforce numbers weren't that good. They're not wrong about that. It wasn't, like, I mean, as we just went through the numbers, we're like, okay. Like, they're okay. This isn't great. And, like, you know, I'm in Salesforce, so in fairness, like, I should be really happy, but I just, like, a little tempered on the enthusiasm when I actually go through the numbers. Salesforce is projecting a slight pickup in the second half in organic growth. Signing new business or persuading existing customers to spend more. Yep, that was in our 10Q as well. We saw that. All about expectations. Overreacted to selling down software stocks. Correct. Tech deal spray. Okay, this is another. Who's this blondie? And newsletter. Okay, this just goes into other crap. All right, whatever. Short little piece. But it does sort of lean in on, oh yeah, software's back. NVIDIA, look at this. Oh, 4.25 now. Damn. Soxel so cooked. Wonder how Sox is doing. Sox. Ooh, Sox is down 3, which Soxel's gonna be down 9 then. Soxel, they're about 10. Yeah. And then on the day chart, that NVIDIA relief rally was very short-lived. It was only up 6% that day. I'm actually surprised. Wait, on the average it says 6%. Let me check the unaveraged. Oh, worse. 5. Oof. Yeah, that has been a little cooker. All right, let me listen over. What's this talk about NXP?
That's why, you know, you're seeing it down today.
Max says, I missed her. I know, me too. She's not around as much anymore. Well, this is bull crap.
To how many more cars gets produced, because as you know, everyone who's looked at cars, more and more intelligence goes into cars now. In other words, more and more chips. So the chips are growing faster than the cars. The second way is really the fact that there's this backdoor, I'll call it AI play, a different kind of AI play, not the hyperscalers play. It's more a play on intelligent automobiles, self-driving, robotics, industrial automation. We think that's maybe the next wave of, it's already happening, but the next wave of AI spending. And you're getting it for stock that sells at 12.5 times earnings. So to us, that's super interesting.
And then finally, you know, I took a picture, I don't know, about a week ago, posted it to the X of a deli saying basically paying cash, save 3%. I'm starting to see those signs a lot more. Companies are like, you know what, paying cash, but that doesn't seem to be dissuading anybody. And maybe another reason you like MasterCard, because what, 1/3 of all transactions, even with a slight discount for cash, are still coming from cards.
Yeah, and I think the interesting thing to me is you just say to yourself, it's just a way to have I'll say a toll booth on global spending, right? MasterCard's very...
Suck your toll booth.
budgets. It's also, of course, other imbalances in trade that we have been talking a lot about, and we need some solutions to.
You were talking about how it's important for global central bankers to come together and to have a conversation, and a big part of that conversation is artificial intelligence and how that's transforming the landscape in ways that are somewhat unpredictable and difficult to discern. Do you get the sense that there is agreement that it is more inflationary than disinflationary? Where is that debate kind of coming down during your discussions here?
So my personal take on it is we don't know, and there might be different points in time where it has different effects. Perhaps at the beginning it might be more inflationary because you need resources to build data centers and so on, and that could increase inflation, at least slightly. In the long run, of course, it increases productivity. It allows for higher growth levels. It might be disinflationary, but it's really too early to say. We have lots of academics around us during the meeting, and there's different opinions.
We need to do some summaries. Oh, we got some big summaries to do. Not just software, but what is this? Iran's supreme leader urges authorities to avoid any discouraging statements that could weaken national motivation. It's a crazy line. Fed's Goolsby, don't see a conflict between Fed and Treasury. Trump's gonna create a U.S. Space Academy. I'm out of coffee. All right, that's boring. Okay. So, first things first, software. And then we'll talk about the Fed. Let's get Notion in there as well. Why don't we? You can talk about the software harness, I guess, in that too, which is actually really relevant the more I think about it. And, we need to get up the numbers for Salesforce on its beat. I have those handy. Those are IREN. Oh yeah, IREN reported as well. I don't imagine that with NVIDIA going down right now, IREN's doing very well. I'm just gonna quickly cheat. IREN stock. It is, it's down 13% today. The hardware's just getting spanked. Salesforce, here we go. Got it. The Palantiring of your data. Okay, yeah, perfect. Okay, great. All right, software summary time. Okay. Quick reminder, coupon code JHOLE expires today. But folks, we've got to talk about the software bottom. This is finally happening. Literally across the headlines, Wall Street learns to love software again. The headline is, forget the SaaS-pocalypse, it's a SaaS renaissance. Science, anyone? Anyway, finally, we are getting the bottom in software. If you've been around this channel for the last 6 months, we've been calling for a software bottom in Q3 and Q4, specifically after what we called the SpaceX suckening, which is them sucking money out of the economy and recycling it into NVIDIA, top of funnel, right? Software has gotten so cheap that there was a point where Salesforce stock, which we have exposure to, we sent a buy alert out on Salesforce specifically when it was about $165 because it had about a 13% free cash flow yield. And Mark Benioff literally raised $26 billion of debt to buy back $25 billion of stock at about $191. So we looked at that setup and we're like, this thing's trading for a 0.9 peg. That's a price to earnings growth ratio. We can buy it at 165 for less than what the CEO just bought it back for. And even though the bottom's not in yet, when it comes, it'll probably be pretty aggressive given how cheap the valuation is. And so Salesforce is just an example of that bottoming happening in software. But it's not just Salesforce that skyrocketed. I mean, you could see when we bought it around 165 in this lower range over here, it fell more. It fell down to 146. But since the third quarter, roughly the third quarter, which started right here in July, since the third quarter, we had this almost perfect rise in not just Salesforce, but another one that we own and have exposure to, which is Palantir. We got at about 118, sent an alert for that. Palantir's exploded here in the third quarter. But you're now seeing software expand. You're seeing a recovery in Atlassian. You're seeing a recovery in UiPath. You're seeing a recovery in ServiceNow. A little bit of a recovery in Workday, though not as much. Sorry, that was Monday.com. Workday's recovering. Axon has bottomed. And even QuickBooks, Intuit, is trying to get out of there, though that's one of the ones that's lagging a little bit. It still has recovered most of its pain from earnings. So what's going on? Like, is the software bottom over, and is it too late to get into software? And what's software doing to try to minimize some of the expenses that are going, frankly, into software? See, tokens we know, because when you look at margins for companies, whether it's at Salesforce or at UiPath or at Palantir, tokens are increasingly costing these software companies money as they integrate tokens into the services that they're offering. But there's some really cool things happening with tokenomics that if you don't know about, well, you're going to want to know about them. First, let's take a quick look. Before we mention this tokenomics change, let's take a quick look at a potential valuation, even still from here, because for Salesforce and Palantir, or even UiPath, because I know a lot of people are asking, well, Kevin, like, why do I care? If I missed the boat and the software bottom's already happened, is it too late? In my opinion, the answer to that is no. And so if I look at our stock data tab, I've got UiPath at $32, 75% upside from here. Honestly, I think this is probably closer to 40 to 45 bucks. I've got Salesforce with a fair value of 458, which is still a double from here. We'll go through some Salesforce numbers in a moment, and I'll show you the positive, the green shoots, and I'll show you some of the red flags. And then we've got Palantir, which I also think is probably at, I think we're running this at like a 2.5 peg right now, which brings it to about a 222 fair value. Honestly think that's about 20 to 30% too low. So I think there's closer to 50% upside on Palantir. This is one of the tools that we're still building and improving. It's a tool we've only had out for a couple months now. We're really excited about it. But beyond that, let's focus on what's going on with this innovation in tokens. And it all comes down to what's being called the harness effect. And it really relates to how software companies can not only make money, but how they can make more money. And of course, we love nothing more than doing our best to put analysis together and make money. Which is why not only should you subscribe, but you should take advantage of the coupon code JHOLE expiring today. Get all 9 courses, every private live stream, every alpha report, and every trade alert. Tax professionals say this could be a tax write-off. And of course, what a lot of people are doing as well who are already course members, although some new folks are also bundling both of these together. What a lot of people are doing right now is they are bundling together Homes AI with this. This is our proprietary artificial intelligence. It gets better every single month. We've got lots of updates coming for this. But we are removing the lifetime access for this, which means if you lock it in today, you'll keep lifetime access. But anybody else in the future won't be able to sign up for lifetime access anymore. So you could bundle these together if you're new. If you're already a course member, you could email us at staff@meetkevin.com. We'll give you a special bundle code so you could bundle this in and make sure you maintain that lifetime access for life. Okay, with that, let's get into this, talk about the harness effect. So Visa basically, according to the information, spent 3 months and 100 engineers slapping together a harness so that they could have what they call the Visa Vulnerability Agentic Harness, and it basically coordinates between using Anthropic or OpenAI or open weight models and reduces the mess that models make with hallucinations, gives more access to tools and data, and reduces the time for software to actually adapt to situations. How does this work? Well, let's go to the study and go to a little bit color on what they say here. So first of all, think about, somebody in our live stream chat had a great analogy for this. They said, think about a harness as sort of like making a to-do list for your AI. And so what these harnesses do is they clean up the context. They put the right stuff into the right models. They bring in and enable tools that you could pull data from and use, whether they're stored workflows or API access, database access, Salesforce access, or whatever. They orchestrate that all for you to where you kind of become model agnostic. You become results driven. That's a huge benefit for software companies because then they can bring token costs down while still providing equivalent value for their customers. And this is actually very, very interesting. Take a look at this. And sorry, I'm getting a little distracted here. Peel, that doesn't sound good. Good luck and stay safe out there. You're in the Coast Guard, I see, and you got a call from the superiors to get a go bag ready with my documents. Unsubstantiated threat in California. Uh-oh, they're coming for Gavin. Anyway, sorry. Focusing on this here. This piece right here, stay safe. This piece right here tells us, this study from July. This study from July tells us the following, that when you use an orchestration layer, so one of these harnesses basically, when you use one of these harnesses, you end up being able to drive costs down 40%, your time to action down 44%, though this is really seconds, so nominally for a human, it doesn't make much of a difference, and your token usage goes down 38%. Now, why does this matter for the bottoming of the software? And you can kind of pause the screen here and actually look at the core of it right here if you want. I've highlighted it for you. But why does this matter for software? Well, it matters a lot for software because if software companies are seeing their margin affected by token costs, in other words, like let's say a UiPath is like, hey, we're integrating into our RPA, robotic process automation, we're integrating tokens, and we're going to start charging customers for tokens. Best case scenario, the overall bill for the software looks lower if you can provide them cheaper tokens. This is true at Palantir. This is true at Salesforce. This is going to be true at UiPath, whatever. It's also true for companies like Intuit who run artificial intelligence for their customer support. And if they can provide that customer service with cheaper tokens with an equivalent quality, then that's key. In fact, that's what they make the argument here. Quality, they actually say quality holds at parity for task completion. And because token costs are down, overall quality per dollar rises 82%. You have to ask yourself, who wins from this? And this is why I'm bringing out the whiteboard. Who wins? If you use an orchestration layer, does the token provider win? Does the infrastructure layer, the NBIS or the NeoCloud or whatever, do they win? Right? Or does the software company and ultimately the customer win? Right? Who wins when you get token costs down and quality per dollar up 82%? Well, it's not the infrastructure plays, and it's not the token providers. They're actually getting their margin squeezed because you are now in the background commoditizing tokens. Who wins are the software companies providing value, for now, and the customers win, which the customers could be other businesses, other corporations that are winning from those cost savings. Okay, fine. That all makes logical sense. So, is it too late to buy software, and is everybody definitely going to win in software? No, not everybody's going to win. A company that Salesforce integrates with, Legora, they seem to be a great winner. They have basically their GPT platform that organizes documents for cases, and they're crushing it with annual recurring revenue. They went from $100 million or $1 million of annual recurring revenue to now $100 million of recurring revenue. It's insane. Like, there's so much annual recurring revenue money potential out there, which is exactly why we're getting rid of the lifetime access on Homes AI. It's like, let's turn this into ARR. Being very transparent here because obviously we want to, in the future, hopefully IPO the startup. ARR is good for that. Anyway, so what does this mean for all software companies? It's still picking and choosing. See, Notion, for example, the information has this piece about how Notion is making this all-in bet on AI, but the problem is Sensor Tower is reporting that its mobile app usage is falling, which suggests, is AI replacing Notion? Or can AI actually enhance what the company is doing? And this is where it sort of depends on a company-by-company basis. And it's a little complicated and problematic potentially, so not so clear. So if we now jump into, let's go to Salesforce's documents, we could get a little bit of color about where the red flags sit. So, and keep in mind, we own Salesforce, we're exposed to Salesforce, exposed to Palantir, like we're up on these, we're really excited about them. We've been studying these software plays for months with our course members. And I do have obviously an upside bias on these, but I want to be clear, I'm also going to be critical. So that's why I'm going to start with some of the red flags here. So take a look at this. If we jump into a red flag over here, we can see that Salesforce is telling us that their primary increase in revenue came from new business, which includes not only new customers, but also additional subscriptions from existing customers. That pricing was not a significant driver for revenues. Now that could cut both ways. I could say we're going to hook people now and raise prices later, or we could argue that we didn't want to take pricing because we didn't want to get people to cancel and leave us. They didn't want the attrition. So you don't take pricing and you just try to sell people more AI features without raising prices on the existing. That might be a sign of weaker pricing power. That is important. In addition to that, they say here, there was a decrease in the spend for professional services, which you can see right here, about a 4% decline in professional services. Why? Because there was less demand for larger multi-year transformations. In my opinion, that's a red flag. That's a sign that what you're doing is you're basically taking this existing sponge and you're like, we won't raise the prices because we don't want to lose them, but let's offer them more AI stuff and squeeze the sponge. And to me, that kind of aligns with this announcement that they made regarding Claude Force, that Claude Force runs Salesforce headlessly through Claude. So Claude gets direct governed access to Data 360, Tableau, Slack, all your Salesforce crap without leaving the chat. I kind of call this the Palantiring of your data. You have one layer where you could interact with all this data and you get fed what you need when you need it. That's good because it's all in one place, and then it reduces the lookup time for you actually trying to find data, update data, process data, and it lets you focus on making the decisions. Obviously, there's a limit for how many decisions you really need to make, but, you know, to me, this is good. It makes you more efficient when you do need data to make those decisions. Okay, cool. So what does that mean? Well, what it means is if you're not really growing, are you really justifying these massive moves up in price? Probably, for now. It doesn't mean it's going to last forever. At some point, companies might end up sort of, you know, if you're operating through Claude Force, you might end up just rebuilding the Salesforce stack, which is literally the reason all of these companies ended up selling off in the first place. Everybody thought people were just going to vibe code away the Salesforce and they won't need Salesforce anymore. Right now, that's not true. But those seeds of pain still exist. The good news is the company got really cheap. And even though they barely beat, the stock skyrocketed. That operating margin came in at 34.1% versus 33.6%. That was a beat. But RPO, remaining performance obligations, only grew 14%, which was a slight miss. Subscriptions beat, but only by 28 basis points. So forecasts for Q3 also beat at $11.46 billion, but only a 35 basis point beat. So it's like, these weren't really good earnings in terms of expectation versus reality. I think what happened is, the reason we have these large candles is because these have gotten too cheap. They have gotten too oversold in the SaaSpocalypse. So let's look at the valuation for the company. You know, what's a company like this actually worth? Well, let's look at the income statement. So if we look at the income statement, we can actually see that gross margins compressed a bit. We went from gross margins at 80, this would be 83.1%, once you minus 1 on it, 83.1% compression down to 81.4%. Gross margin declined therefore. Revenues are only growing at 10.8% year over year, stable, better than obviously shrinking, but their costs went up 18%. So you have shrinking PP here. And again, I'm saying this, like, I have this tendency of being critical, like really critical of the things that I'm exposed to. I should just be the hype man, right? But I also want to look at the red flags because that's the reasonable thing to do, so you know when it's time to get out. Anyway, they're bringing 31% down to the net, which is really good. When you're bringing 31% down to the bottom line, $3.5 billion out of $11.3 billion, you deserve like a 2.6 peg. And so if we actually do the valuation on that, add a 2.6 peg times 10.5% projected EPS growth over the next 4 years, times their earnings per share projected January at the end of the year, 1671, we get to a valuation of mid 400s. And honestly, it could probably reasonably hit the mid 400s and then just momentum boom past that. If you momentum boom past that, that's when you A, stop allocating, and B, maybe you set a trailing stop and it's time to get out. But like, why get out now? You're still early in the process. This puppy's just starting to boom, right? That's true for many software plays, whether it's Atlassian. In our course member live streams, we've done quite a lot of analyses on Atlassian. Great balance sheet, great growth. Obviously you can't pick all of them to invest in. Like ServiceNow is another one. It's good. It's not my favorite. I preferred Salesforce over ServiceNow. But does that mean I'm bearish ServiceNow? No, not really. What about Team? Same thing. Not bearish it. Problem with Team is when you analyze Team, if you look at their historical margins, they're really bad. And they're inflecting up in the recent term. And hopefully that keeps going with artificial intelligence, but you have to watch for those red flags. So what other red flags do we see in these software companies? Well, let's take a look at it. Here, I wrote that underneath the Legora, Repli, Xero is a platform for accountants, a finance platform, 5 million subscribers. Agentforce handles the customer support at scale. Legora uses Salesforce for audit trails and governance and compliance, blah, blah, blah. The underlying concern that these companies in the future can still optimize and replace Salesforce exists. And going, headless to integrate into Claude kind of suggests that those underlying issues aren't going to go away. And if there's ever a recession, that's going to be the time maybe that the companies are like, all right, it's time to optimize for costs. Where can we cut? So if I go through here, I look at the limiting factor, few limiting factors. One is obviously the interface limiting factor we talked about earlier of like how many problems do you really need to solve. That's a limiting factor for AI. But another thing is at some point, the growth from introducing artificial intelligence products slows as well. If we go back over here, I want you to see growth from AI. It's right here. It is growing right now faster than the core business. The core legacy business is right here, so I'll highlight it in orange. Agentforce apps. Agentforce only grew 7.6% year over year. The headless and the Data 360 AI stuff, that grew 20%. So you are getting more gains right now from selling those AI products to the existing customers. As long as that keeps growing, you could keep seeing this stock go up. That's my expectation. Once that growth starts slowing down, that becomes your bigger red flag. So that's the income statement. That's where the income's coming from. If you look at the balance sheet, we do have long debt of $45 billion, mostly financed at about 1.5% greater than treasuries. That's your spread, your yield spread. And then about $25 billion was used to buy the dip on their own stock at about $191 per share. They have enough cash to pay their bills, and their cash flow yield is still good. They are yielding about 7% right now. And even if this stock gets fully priced at about $450, it would still yield a 3.5% cash flow yield. which is way better than the 1-ish% that Palantir yields or the less than 1% that CrowdStrike yields. So, SaaS recovery, Q3, Q4 bottom, yeah, it's definitely happening, which is great. And I'm really happy for that. I'm grateful for that. Can it keep going? Like, is it too late to get into Palantir or Salesforce? In my opinion, the answer to that is no. I think these guys can still go. But if you're going to get into those stocks, you have to look at them as they still have underlying red flags. Some of the ones that you should pay attention to, obviously, we've talked about here. Those are the ones that I'm paying attention to. You might have your own red flags that you look at. And that's how you can have an exposure to this while still being careful, if you will. It's still an investment, right? Don't get married to it. So obviously, if you haven't yet, join us for more fundamental analysis over at meetkevin.com. And remember, this coupon code expires tonight. And then we are also getting rid of the lifetime access for this. If you do have the lifetime access before tonight, you will keep the lifetime access for this. So even if it's not perfect in the county where you are now, the cool thing is with the lifetime access in 3 months as the app gets better, then you have it for life. You've already made your investment. You're good. Like, you get those updates, which is cool and exciting. So join us at meetkevin.com for the Alpha membership and meetreinvest.com for the Homes AI app. Cool. All right, next. So let's see here. Let's go take a peek at what L Market is doing now. Okay. Now, let's go see. El Marketo is... Here we go. Okay, so the Qs are at 716, still riding that 715 layer. Wow, that's crazy. Well, let's see if we can hold it, That's the goal. Hold, baby, hold. What are we doing on NVIDIA? NVIDIA still, it's holding on to about 4% here. Meta's trying to recover as well. Salesforce still up 3%. Palantir's basically flat. And then, hardware's getting hit. Although not that bad. Like, SanDisk is only down a smidge. Micron's only down a smidge, 1%. And then, of course, yields are higher. So Tesla's coming down probably on the yield move as well. Let me see the yield move here. Yield move is... almost 4.73 now. Wow. Wow. Yeah, that's high. So. All right, good. We're going to take a break. Thanks so much for being here. And we'll see you for the market close.
Oh, man. Your boy Kevin just lost lots of money. Oh, but that's okay. I am with you, with you. Oh, man. Your boy Kevin just lost lots of money. Oh, but that's okay. I am with you. Here we go. Come on. Push it. Find the dip. Find the dip. Here we go. Come on. Push it. Find the dip. Find the dip. Here we go. Come on. Push it. Find the dip. Find the dip. Here we go. Come on. Push it. Oh, my God. What's happening?
First of all this whining by Wall Street is making me sick. 140% of GameStop was short. GameStop was short. You can't allow Wall Street to short 75% of a stock, crush these companies into the dirt, thousands of stocks into the dirt. Then when the individual makes money, everyone's entrepreneurs. I have a kid who bought a house, paid $50,000 and bought a house. After decades of the shorts, you have to accept the fact that individual investors are playing the same game that you're playing and now you're losing.
Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it. Oh my God, what's happening? Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, push it, push it, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it. Oh my God, what's happening?
Discord who are spamming rocket emojis, yelling, "Go to the moon."